They're just getting warmed up for heckling. That's all it is. All right, welcome to NCRAG 2018. Tonight we're doing Northern Colorado Real Estate Market Stats 2017 in review. I may use different years tonight because I'm still getting used to 2018. So if you hear me say something and you think I'm confused, please do let me know. I'm James Orr. So upcoming classes, speaking of all the classes Brian's teaching, we did the calendar for the entire year. So if you go on to ncrag.com, it'll take you to Meetup. And Holly was kind enough to put out all the classes for the entire 2018 year. One of the things we did a little different this year is Brian had asked last year, and I ignored him, to kind of put some classes that are flexible in the schedule so that we didn't have 50 different classes all scheduled out in case a topic came up that someone said, hey, I really need to learn about asset protection or selling real estate on Amazon or whatever you're going to do. So now Brian has a spot like every 6 weeks or something like, what? You do have like a spot every 6 weeks or so. So there's like a topic TBD. It's not because we don't have things to teach. It is because Brian specifically requested to not schedule those out. So we had some flexibility in case you need to put something in there.
Yeah. If you've ever heard James tell a story that involves me and him, only half of it is true.
What do you mean?
There's from both of us.
Oh, like I get to choose a couple topics too? Well, you're the one that told me you wanted it, so. Anyway, the calendar for the year is this. So next week, Brian is going to be teaching real estate investor portfolio optimization. Brian, what is that about?
We've only taught this class once before, and it's one of those kind of longer-term, bigger-thinking classes to help you, no matter what stage you're in your investing career, if you have 1 unit or no units, or 100 units or 1,000 units, thinking about what do you want in your portfolio, why do you want it, what do you already have, and how should you change that potentially and why, and there's no right or wrong answer, I think is the really hard part of that class. It's make you think so that you're thinking in any stage of your investing.
So I will correct one thing you said. I agree everything you said except for one thing. I think in some cases there are partially wrong answers because part of the class, in my opinion, was to prevent you from making mistakes. And you like to tell a story about yourself about how the first few properties you bought, you voluntarily paid more than you needed to in down payments because of the order that you did them in and that. And sort of like thinking through that again in retrospect, we probably should have changed things. And so now the portfolio optimization class has you think through some of those potential challenges early on. One of the really small points you'll get in this class is the idea that you do not need to sign on every loan with your spouse. You can alternate and do 20 properties instead of being limited to 10 with 30-year conventional Fannie Mae, Freddie Mac type loans. You can actually do 10 with one spouse and 10 with the other spouse, so you can acquire 20 properties in total. So if you didn't know that and you started down the path and you and your spouse did 4 until you found our class and now all of a sudden you're on property 5, you're limited now because now you have 4 that are counting for 4 spots on both of you. And moving forward, you actually have more spots to do between each of you.
Other solutions for that?
Yeah, there's other solutions for that too. Yeah, but that's just one of the type of ideas or something like that for what's going on. Okay, so that's the class Real Estate Investor Portfolio Optimization. Brian's going to be teaching about 2 hours on that topic. And then there's no class the week after that, January 17th. It is totally canceled. It's not here. It's not at wherever they're meeting now, Ryan's or something like that. There's nothing at all on January 17th. However, on January 24th, there's no class in this physical room. However, Brian is going to lead a networking night, and I will not be there. So if you have anything bad you want to say about me or you want to get the inside scoop when I'm not around and ask Brian all sorts of personal questions, that is the night to do it. And where are you holding this?
I think it's going to be at your house.
Yes. It will be at my house, apparently. And my address...
That's for the January 17th class.
My address is 111. Yeah, it's not that address. Okay. So really, what's going on the 24th or 20? Yeah, 24th.
So we're either going to meet at Ryan's or I'm trying to get a new space out at DC Oaks, which is out by HB in Fort Collins. So it's not very much farther away, but it's a nicer space, different food. If you've been to DC Oaks, I think it's the food and the beverages are both a step up. So, and they won't have trivia going on while we're there. So that's a little tough.
Yeah, how many people?
Right now it's probably probably at Ryan's, and I'm not sure that DCOs will comply, but we will
Okay, awesome. Thank you for doing that. So I will not be there. Brian will do it. And I will be out of town for both these weeks. That's why one class is canceled. And Brian, I didn't want to do 2 networking events in a row. That's why we canceled one.
RSVP, and if you RSVP, please do show up, because I use the RSVP number to actually tell the general manager, and if I do DCOs for the first time, and I tell them 30 people are coming and 7 people show up, we will never do it there again.
Yeah, we won't be allowed to do it there again. It's really. And just the thought process, in case you guys don't know, the venues that we have, the restaurants and stuff, if we go there, they expect you to buy food. So we are not buying food for all of you guys. Like you a lot, but not that much. But feel free to go there, order yourself like a drink and some type of dinner. Come hungry, because that is your admission fee. We don't charge for the classes, but the nights we do networking where we have it at a restaurant, we don't pay a fee in order to have the room. You guys pay the fee by paying for food. Okay, so that's what your expectation is. So like at a Christmas party, you should buy food, and at stuff like the networking things, which we do once or twice a year, 3 times a year, something like that. Yes, thank you for buying me my Christmas dinner as well. Thank you.
I have my suspicions.
Yeah, I have my suspicions too. So thank you again for whoever did that. Someone bought my dinner as well. So thanks. Okay, cool. So no class, and then the investor meeting on the 24th, the networking meeting rather. And then on Wednesday, January 31st, I am teaching Comparable Sales 101, how to determine value when making offers and selling. This is the class. I had someone over vacation call me. They had a deal come up. And one of the first questions I said to them is, so what's the property worth? And they were confused by that. So that's like the first thing you need to do if you're doing any type of off-market deals. If you're thinking about selling a property and you're going to try to do something yourself or get creative, you need to know the value of your property. And so this is the class where I take 2 hours and I show you how to determine the value of a property. You could use this class when you're making offers on properties, and I will show you all the amazing tools I have. They're like professional grade, better than what most real estate agents have, tools for determining values of properties. And so this is that entire class, 2 hours of that in detail on January 31st. So please. In a lot of cases, it probably is. So there's some pretty wicked stuff I'm going to show you on that night. So definitely come to that class. I think I've taught it a few times before, but it's pretty amazing. And then again, I only teach one class. Brian is teaching the next one using self-directed IRAs, SRAs, and self-directed 401ks for REI. So real estate investing, and that's going to be on February 7th. What's in that class, Brian?
So this is a comparison. There's two basic things. It's a comparison and an overview of what a self-directed IRA and a self-directed 401k, what both of those things are, what the differences are, and then some very interesting ways that you can invest in real estate utilizing those that are not widely known. So if you're researching them, it's not like they're secret and you're not going to find them, but most people are not aware of different strategies, especially if you have a lot of money, but you don't want to use your, like one of the examples is if you have a lot of money in a self-directed 401k, but you don't want to put 35% down, which is what a bank would require for your self-directed 401k to actually sign on the loan at the bank. There is a very good strategy where you partner up with somebody who can sign on the loan and you end up putting 20% down instead of 35. So there's strategies like that that are very significant in, instead of 35, you're putting 20. I mean, you can almost buy another house with that leftover 15%. So there's some great information in there. Last time, the week after I taught it, people were like, "Can you teach it?" So don't miss the class and come the next week and ask me to teach it.
Which happens almost every time we teach asset protection as well.
Yeah.
So
that was the first. I think we've only taught that class once, maybe twice.
I think it was once. Yeah, I think we've only done that one once.
The second time.
Yeah, it's good. You should come. So basically, for those that don't know, how many people are not getting the newsletter in the mail? Okay, so if you do not have copies of the newsletters, come see Tammy. I'm going to give her all these. But the class schedule usually is on the inside in case you're wondering what the upcoming classes are. And there's a couple back issues of newsletters. I'm going to hand those off to Tammy. Please go up there and do that. And if you haven't checked in, please do that. A couple other little announcement things. Anyone who's here for the first time has not filled out one of these like get to know you forms. So if you have filled out one of those, I will trade you one of these for a book. So Alex, you need one? Anyone else need one? So go ahead and do that. Tammy will give you copies of the Nomad book. A couple other quick announcements. Not this past Christmas. A year ago, last Christmas, I gave away copies of this book as the Christmas gift. I'm not giving them away anymore. They are available on Amazon if you want to. This is the How to Acquire a Multi-Million-Dollar Real Estate Portfolio with just $3,000. It is based on a property in Windsor. So if you want to know how to do it in our local market, that's this book. You can buy them on Amazon. Clients, if you have not gotten 2018 version of the client book, come see Tammy afterward and we can give you a copy of that. And then, how many people came to the Christmas party? How many people did not come to the Christmas party? Okay, so by not coming to the Christmas party, this is what you did not get. Okay, so this is the $297. There were 50 signed, numbered, limited edition collector copies of this book. And everyone who came to the Christmas party got a signed, numbered edition. Is that correct? Anyone not get one who came to the Christmas party? Okay, so if you didn't come to the Christmas party, this is like one of the last copies I have. I'm not selling it because I want to be able to show it and tell you what you guys need to come to the Christmas party. So everyone got a copy who came to the Christmas party, but I just want to show you what it was so you guys know. And that's all the checklists for buying property, converting it to a rental, managing a rental property. It's got like 440 pages, literally, of checklists. And every single page is just a new checklist on how to do all of it. Anyone look through it since Christmas? No one looked through it? Yeah.
So how can you get it?
You cannot. There are like 50 limited editions. They're no longer being printed. There's a web-based version, but there's no books.
Better as a web-based version.
Yeah. That's why Tammy made me make it a collector's edition. She says no one is going to go read through 440 pages of checklist. What they really want is the website where they can click off what they did and use that for property. So that's what it is basically there. All right, so introduction. So who are you, and then what is your favorite or most important market stat and why? And then please, where is Daniel? Please do not take photos of slides. He's going to listen to the recording. He's going to be like, every single time you mention me on this. This is why I don't come to class. Please do not take photos of slides or record audio, video of NCRAG presentations. I do try to record this. Recordings have been historically available for clients on James Orr Real Estate Services, the website. However, we are talking about, if I made the NCRAG classes and all the Nomad content, if I made them a podcast that was free and open to everybody, how many people would listen to them? Like one? Raise your hands high.
I'll raise them both.
Okay. All right. So I probably need to do that. So we're probably going to make the classes we do here, all of them open, including back ones, if I can figure out a way to do it, available as podcasts for everybody. And Brian's looking at me with really big eyes like, oh my gosh, why are we doing that? Because I have not talked to him about it.
I don't think you need to.
That is also true. Yes, this is a power struggle that I won for once. I think I won.
When I sell a $30 million house.
We could talk about that. But you know, all it does is raise the price for me. That's all it really does.
Right.
So I still won.
Still free. I don't know if you won.
Okay. All right. So anyway, who are you? So Joe, who are you? What's your favorite or most important market stat and why?
I thought this was win-win, by the way.
This was win-win.
That didn't sound win-win to me.
It was win-win. You felt like you won. I felt like.
Class of the year 2018, not win-win for James.
What do you mean? You felt like you won, right?
You just told me I lost.
No, you felt like you won.
I felt like it was a good deal for both.
That's true. That was win-win.
Hi, I'm Joe.
What's your favorite market stat?
I would say my most important one would be migration.
Doesn't have it.
I don't have any slides on that.
All right.
Brian's going to bring back all the data from another market stats class where they go into like population trends and all demographics, stuff like that. I don't do that. I do all real estate stuff.
All right.
So, yeah, there's a ton of stuff.
That's my most important.
Awesome. Josh.
Josh, and I'll go with vacancy rate. Because I know you don't have it, that's why.
All right. All right, David, let's see what you got.
Hey guys, David. I'll be easy. James. Prices.
Nice. I got price stuff. I got a whole bunch of stuff on prices. Thank you. I appreciate that. Hello. Who are you guys, and what is your favorite and most important market stat and why?
My name is Brad Bowles, my wife Shauna, and most important stat, I would probably say the difference between asking and offer price, maybe your sold price.
Okay. I don't have offer price. I mean, you know why, but we do have sold, and we do have list price and sold price. So I will show you a whole bunch of data on that. It's going to be good. Thanks. Welcome. Hello.
Hello. I'm Nick. Let's say rental rate. Rental price.
Like rents?
Yeah.
I have a slide or two on that. Not very many, but thank you. I appreciate that. What's that? I'm not an expert on rents. You know this to be true. James, what do you think it's probably rent for? I don't know, 1,200, 1,800? What did I tell you it was going to rent for? What did you rent? Whatever I actually rent it for? I told you like 1,200.
It was only 400.
Only 400 off.
Yeah.
In the good direction, though, right? You were. See, I want you to be conservative. Thank you. Hi.
My first thought was vacancy rates.
Okay, so that legit vacancy, not just because I don't have it. Okay, awesome. Thank you. Hello.
Melissa, I'd say days on market.
Okay, I got that one. We're going to cover that tonight. Thanks.
I'm Paul. I like to hear about compounding growth.
Compound. Like the appreciation rate?
Yeah.
Okay.
Single family, multifamily,
I got some of that. Awesome. Thank you.
condos.
I don't know if I broke out. I didn't break out condos and townhomes because Brian told me it's too many slides. Thank you. Welcome. Hello.
I'm Tony, and probably days on market.
Awesome. I got some of that too. Thank you. What's up, birthday girl?
I think I like the one that is like how many houses are available versus how many houses are needed. So thank you.
What was it?
Inventory.
Oh, like months of inventory?
Yeah.
Okay, awesome. I got some of those. Yeah, I have like a months of inventory absorption rate. Thanks, welcome. Hello.
Hi. I'm Lashana and I'm sorry.
She threw you off. I think you were going to say price.
Price per square foot.
There you go, price per square foot. You're welcome. Awesome, thank you. Hello.
Hi, I'm Alex. As a student who's looking to get into real estate in the near future, I thought I'd just say price as well.
Awesome, thank you. Welcome.
I'm Anna, and I'm thinking multi-unit, so prices and days on market and are
Okay.
they available?
I have a couple of those, so we'll cover some of it. Thank you. Hello.
Tammy, days on market.
Nice. Welcome, Tammy. Is this your first time? Awesome, very cool. First time this year. Hello.
Well, I'm Brandon. I'd probably go price per square foot.
Nice. Got some of those. Thank you. Welcome. Hello.
Hi, my name's Bob, and it doesn't sound like you have the data that I came here to see, but vacancy is what I was interested in.
Okay.
Who's moving to Fort Collins,
Don't have that?
all of that stuff.
Okay. So vacancy in northern Colorado is about 3%, but I don't have charts on it. And it's acquired in a very odd way. It's polling usually multifamily properties, so there's not a lot of good data on single family homes. And then demographic data, Brian's going to go cover that like in a couple weeks.
But I mean, like, even vacancy rate, like, if you really want vacancy rate for single-family homes or something like that, call up your property manager or call up a property manager and ask them what their personal vacancy rate is across their 1,000 units. See if they'll give it to you.
But then also data like how many units are coming online in the next, next year. I mean, as you drive around Fort Collins, you've got the cycle complex over by.
You're talking about new
So a lot of
builds
that
and
data I brought back last year, and it all depends on what data they decide to share, right? But the current market from last year was, there still weren't enough to handle it. Right.
I will show you that this year and the results. Yep. Yeah. Awesome. Thank you. Hi.
Hi, I'm Barbie. I would say rents.
Rents. Okay. I got a couple charts on that. I didn't do a ton of rent stuff, but thank you.
I'm Lynn, and like new construction of condos, I think we're always talking about the same thing.
Like how many are coming on?
Right.
Yeah. I don't have that data. I don't know if there's an easy way to get it in a consistent way. There's ways to do some sampling, but I don't know if it's good.
Oh, one further question would be,
Yeah.
the state of Colorado changed the condo law.
Yep. Oh, did they actually
I think it did.
Oh, okay. I didn't know that actually.
Favorable for builders, and I was wondering if that's maybe different.
I didn't know that passed.
I didn't think it passed. I knew they were working on it, but I wasn't sure that it passed. I'll look it up.
I had not heard either. Tam's gonna find out.
Okay, I could be wrong, I thought.
Yeah, because that's a big, that was the big,
The condo defect law.
yeah, people building higher-end apartments 7 years from now, once they're past the 7-year mark. Yeah, that was.
What's the 7 years?
It's past the statute of limitations for being able to.
So basically, if you're in a condominium complex and you and I have the same problem, we can have a class action lawsuit for 2 months.
Right.
condo that I own actually had that problem when they went to the builder.
Yeah.
So it definitely happened.
I did that too.
Yeah, that's why there's a law. It's because builders don't want to build them with that challenge. So just so everyone knows, one of the reasons why I've been reluctant to make these podcasts is this is not picking you up in the audience on mic, and so the first like 30 minutes sounds like me talking interspersed with.
I think we actually just need to pass this.
Yeah, we could do something like that. Brian, who are you and what's your favorite market stat?
I'm Brian Williams, and I probably like all sorts of them, but I really like kind of inventory levels across the year and appreciation are probably the two of mine.
Like inventory? Like how many things are available?
Yeah.
That's actually pretty cool.
I'm sure you have it.
I do. Awesome. Thank you. The Brian's sitting together tonight. Brian.
I am also Brian, and I was trying to figure out if I wanted to be difficult or nice to you.
2018 started off right.
I agree.
Don't hesitate.
So we'll say I like multifamily. It's kind of my jam. So we'll say multifamily.
Like how many there are?
Yeah, how many have come on
Okay.
last year?
I'll show you that data. Awesome. Thanks.
I'm Elijah. I like to see probably a price per square foot or either months of inventory.
Okay. I think I got both those. Awesome. Thank you. Hello, friendliest N. Craig member 2015, who has not been at all in 2016 or 2017. Was it you actually won 2016, right? You were like N. Craig friendliest member, and then 2017 just like disappeared. You're like, I got my award. I'm never going back. I think that's what happened.
Hey, she's been here every one of 2018 now.
She has. She has perfect attendance this year. That's really good.
We aren't sure yet.
My name is Jamie, and my most important market stat, I think appreciation.
Okay, good. Awesome. Thank you. Welcome.
I'm Royce, and my favorite market stat is probably
Miles from Brian. Okay, awesome. Thank you. Welcome.
Yeah, I'm Kathleen, and I have a couple of population, demographic, and then income levels.
Okay, I don't have any of those.
That's my jam.
Yeah, Tammy. Brian will actually go look those up and get back to you in a future class. He will. He actually goes to like these other ones where they do that data. I don't do that data. I have like more than 2 hours worth of data from other sources. So, thank you. Sorry. Hi.
I'm David. Actually, I was curious on how the new tax bill affects the real estate industry.
Yep.
There's a class.
Yeah, I was gonna do this class with Jason actually. Yeah, I haven't done it yet. I'll tell you, it's favorable for us. One of the favorable parts is the new LLC code about pass-through taxation for entities. But I don't know. I'm not an expert on that. But I know it's better for us. So awesome. Thank you. Hello.
Hello, I'm Alan, and my favorite stat is the population in and out. But I'll take appreciation.
As a consolation prize, we'll just talk about appreciation. Awesome. Thank you. Hello.
Hi, I'm Caroline. I'm looking at purchase versus rentals and supply versus the demand in the area.
Okay. Purchase versus rental. I don't think I have that chart. And then supply versus demand. I think that's as close as I'll get to that as months of inventory, which takes into account both the number of properties that are listed and then also the number that are sold.
Like
So.
purchase versus rental, like how many are owner occupied versus rental?
Yes.
The area?
Yes.
I could go pull that data. My gut is about a third of them are rentals. About a third are investor bought.
There's the 1/3.
Yep. I'd have to go look that up.
62 and 67% That's where it usually falls.
Yeah, I'd have to go verify that data, but that's the number that's coming to mind.
Are you looking at just Fort Collins?
No, that's actually a pretty standardized number nationwide, but it might be off a little bit here and there, but it's not like extreme. It's not like 1/3 versus 2/3 the other way. It doesn't get that extreme. Yeah, you're welcome. Hello.
I'm Nick, and I'll say days on market.
Yes, days on market. That was the easy one. Thank you. Hello. Did I get you ready?
No,
Oh, okay.
Jim. I'm so new to this, I don't yet have a favorite, but I'm intrigued by all the ones that were mentioned.
Okay, good. Yeah, that's
Eager
good.
to learn.
Cool. Thanks. Welcome. Hello.
Hi, I'm Mike. Been pretty idle over the past year, so you can pretty much tell me anything, and I'd be grateful to hear it.
Okay.
But as I wanted to do with folks this year, so days on market as it relates to holding costs, I suppose.
Okay, I'll show you some days on market, but I also have some flip data, like how many flips there were in profitability. So that'll actually be some interesting stuff for you. Oh, no worries. All right, cool. So Northern Colorado Real Estate Market Stats 2017 review. I'm James Orr, in case you didn't know. So I kind of like to start the stats slides by talking about history does not repeat itself, but it rhymes. Because we want to go look back at what happened in the past, not because it's going to happen exactly the same way in the future, but because it's going to look similar to what has happened in the future in many cases. It may not be exactly the same, but it's going to be very similar. And that's a Mark Twain quote. So one of the things we want to know what has happened in the past is so that we can overcome fear. You don't want to go and think, you know, I'm afraid the market's going to go down 50% or market's going to go down 30%, when historically that's never happened in our local marketplace. So we want to look back at what's happened in the past so that we can overcome our fear and move forward in doing that. So that's one of the reasons we cover and study past market stats in NCREG. So last year when I taught this, Brian's biggest complaint to me, by the way, and for those that do not know, after the class, Brian and I usually go grab dinner somewhere, and it's his opportunity for him to tell me all the things I messed up in front of class and all the complaints he has about how I present and how I smack my leg and you know, how I dress funny and I kind of stand here. What's that?
You switched our names. This is what you do to me.
That is not true. I always tell you did a great job. Here's dinner, right? Isn't that how it usually works? So anyway, so we go after this thing, and one of the things he said to me a year ago was, you know, James, that was a really good presentation, but you can cut out about half the slides. You do not need to separate them down and do condos versus single-family homes. And you know, you're covering like 7 cities. We really only care about the 4 major cities. So I said, okay, great. And so what I thought is, hey, if I could even narrow this down even more and make it like one single stat, then it would be amazing. So I created the Williams Market Score. This is named after Brian Williams. And so I basically
actually have a filed trademark on that?
I do actually. It's trademarked.
He trademarks it everything.
I do trademark everything. That is also true.
Don't trust the trademark.
And so here is the formula for those of you that want to go study it after the fact. It does take into account, just like Brian's spreadsheet, that February, when we have a 29th day, you need to make that adjustment on the spreadsheet so that it adjusts it. We take that into account, I think, here, days of February. So there's a whole bunch of things here this takes into account, and this is the actual score. So our marketplace here in Northern Colorado is 1,354,331,000.45. It is down exactly 100,000 since last year. So for those of you that want to know what the score is for our marketplace, that is what it is. So here are the stats that I'm going to be covering tonight besides the Williams market score, because
For those of you that are confused, that's total bullshit.
all right. On that note, so what I will cover tonight is supply and demand, number of listings, number of properties sold, months of inventory. I'll cover days on market, the sold price compared to the list price, so that you can see if you happen to bid above asking price or below asking price, if you're able to get lowball offers accepted. I'll discuss some fix and flips and some distressed properties, like where they come from, things like that. I will also discuss cash on cash return on investment and what those numbers look like in our marketplace. I'm really surprised that no one actually named this stat, but it is actually one of the most important ones, in my opinion, about what you can do, because it's how much cash flow you're getting on your property. I guess you sort of named it when you asked for kind of what the ratio of price to rent was. So that's sort of like that, but it's a little bit more involved. Again, the theme is fewer cities and charts. We're going to go a little bit deeper into the data. I'm going to post the recording and all the charts for clients on the Nomad site and James Orr. And I will link to all the data. So if you see these charts, there's going to be usually a link in the either bottom right-hand corner or the upper left, and it's going to show you a URL. Clients of mine will be able to go there and get data updated throughout the year. So every day I upload the data and make sure that the charts get updated. Some of these charts you're going to want to do real time. You're going to want to see what's happening in the marketplace if you're about to make an offer. And so you have access to all those. You don't need to wait till next year to do that. If you're not a client, you need to wait till next year, because that's the only time I kind of release it to the public. Okay, so basically your clients will be able to do that. Oh, and tonight is intended to be a discussion. There's a great quote from The Godfather, I think it's Godfather Part 2, where Michael Corleone is talking about it. He's like, this one time I will let you ask about my affairs. This is your opportunity tonight to ask me about market stats. So if you have any question about market stats, feel free, okay? So go ahead and do this. And when I started, well, you can ask me any other time too. The other interesting thing is Brian loves to do these little smiley faces in the presentation. So in order to confuse as to whether Brian made the presentation or not, I started adding smiley faces to ours. So just randomly. So this is a little smiley face right here for Brian. So now we don't know who wrote this one.
So before you get going, Tammy sent me the email. So House Bill 1279 actually passed and was signed by Hickenlooper. And
Oh.
Which isn't like a huge, like it's not a total win. It's not like you can't have a class action lawsuit, but now you're going to have 50% plus of your homeowners who live there actually sign off on it.
When did that pass?
I think May.
Oh, really? I haven't heard about it.
But it sounds like they were saying there's still more obstacles. It's like just step one to try to get the construction really kicking again.
Yeah, it's the date on the article is May 23rd, which is crazy because I haven't seen anything about it.
Neither did I. I haven't heard anything about that.
That big of an impact is my impression.
Yeah, but it's weird because it says so many people wanted a ceremonial pen that Hickenlooper wrote 1 or 2 letters of his name at a time as he signed the bill.
All right. Sounds good.
So the builders must have all been like, yeah.
Yeah, that's crazy. I did not know that. All right, cool. So number of new listings. So we're going to start with number of new listings. Fort Collins is blue, and it's primarily what it is for all night. Greeley is green. Loveland is, I'm sorry, I'm like colorblind. Greeley is red. Loveland is green, and Windsor is yellow. It shows you that Fort Collins is by far the largest city for the number of properties that we have listed for sale. Each one of these dots is a year. So this is back to 1997 when I started keeping track of stats from MLS, and then this is 2017, a full year's worth of data. So you can see Fort Collins was up. We had the peak of inventory back in about 2005 or 6, somewhere around there, and then we had a steady decline. Looks like the low was in about 2011, and then it's kind of been snaking along, going up and down here, where this year, 2017, we had just under 4,000 listings in Fort Collins alone. Okay, it is up from the previous year, so 2016, we had less than we had in 2017. Red is Greeley. Greeley is down a little bit. Loveland is up a little bit, and Windsor is actually up a little bit. So one city actually had fewer listings for sale, Greeley, than the other cities, which all went up in inventory. Now, not up a ton, right? And it's nowhere near the levels that we were back in 2005, 2006, but we are making some progress. We are seeing more properties come on the market. Does that make sense? Okay. Yeah. No, please interrupt. Anyway, everyone can ask questions. This is like the one time you can ask about the family business. No, please ask as I go.
Quick question, did that include like withdrawn listings or is it sold listings?
Basically, if it showed up in the MLS, I counted it.
Okay.
So if it actually, yeah, it's not sold. This is just number of properties listed.
So it could have been withdrawn, expired,
Yep.
sold.
And I'm going to show you solds later. And I'll show you the number of those, which the numbers are a little bit off on those, so I'll show you what I mean. Oh, by the way, this is the URL if you want to go view the updated charts, clients can. So here's the numbers of those. So Fort Collins, in 2016, there were 3488 listings. In 2017, 3834. It's up 9.9% year over year. Okay? Loveland, 2138 to 2159. It's up 1%. I consider that basically the same. Windsor, up 11%. 1,120 in 2016, 1253. What's going on in Windsor? Why are we seeing a huge increase? Are there a lot of people trying to sell things because they want to get out of Windsor? Is that what's going on? No, it's all new construction. Tons of new neighborhoods in Windsor. Okay? And then Greeley, 2277, down 13.8% to 1962. That, in my opinion, is pretty significant. We saw a pretty significant decline. I'm going to show you some detailed data on that in a little bit because you'll see that it wasn't like you'd expect it to be. One part of the year was worse than the other, and I'll show you why. Oh, if clients want to do this, you can go to the chart maker and make a whole bunch of variations on these charts. You can narrow it down by range of date. You can narrow it down by price. You can narrow it down by attached or detached or combined, HOA, no HOA, things like that. You can just show me 2-bedroom properties or just show me 3 bedrooms, compare 2 bedrooms to 3 bedrooms. You can see duplex, triplex. You can do all sorts of crazy stuff using the chart maker to do that. So what I want you to start thinking about, though, is what's causing our market to be hot? Because in case you didn't know, our market is hot. So what's causing that? I want you to start thinking about that. And then what's a normal increase or decrease in the number of listings in a year? What would you expect to see if we had a just nice, healthy market just kind of putzing along? Okay? And then what do you expect for price and days on market when there are more houses available? If you start seeing more houses for sale, what tends to happen to price? Does price continue to go up or does price go down? You would think it would go down. What about days on market? If you have more houses coming on the market, how long do houses sit on the market for? Longer. That's what you'd expect, right? And so we have 3 markets that increased, but did we see a decrease in price and did we see a decrease in days on market? Right, and so we're going to see that data. But that's what you'd expect. All right, so number of new listings. This is the same chart as before, except instead of showing you just yearly, I wanted to break it out and show you quarterly numbers as to what happens. And one of the things I want to point out here is there is seasonality. we see that there are more listings in the summer months than there are in the winter months, right? Because this is like January. So you can see there's actually a peak in the two quarters in the middle of the year, and so you can kind of see the difference there. Okay? Same data though, all it is broken out by quarters. Any questions on this one? Sweet. All right, so number of listings, seasonality, all cities. Do we see more listings in summer or winter? How much more? Okay, so the rule of thumb that I did some really rough math on, I haven't checked it recently, but it's been true for a long time, is about 60% of the listings happen in the 6 months over the summer, and about 40% of them happen over the winter. So you would think that that's actually not a big difference, 60% to 40%. But really, when I explain it to you that it's 50% more in the summer than you have in the winter, it sounds very different. It's the same way of describing it, right? You're going from 40 to 60, it's 50% more in the summer. Does that make sense, everybody? Okay. So how extreme is the difference? Talk about that. What does that mean to us as investors? So you're an investor out there in the marketplace. You want to go buy a rental property, you want to go buy a fix and flip, you want to do a lease option, you want to do a Nomad property. What's the best time typically to buy? The winter, right? You want to go when there are fewer buyers out there, the sellers are more motivated. Someone who is putting their property up for sale between Thanksgiving and Christmas is probably more motivated than someone who's waiting till the spring to try to get the best price. Would you agree with that? Yes. Now, are there exceptions to that? Are there people that put their property up for sale on Christmas and they're not motivated at all? Sure. But over the big picture is, if you're kind of looking for a deal, you tend to get better deals in the winter. And I'm going to show you some data to support this tonight. Okay? So you do get better deals in the winter. What's the downside of buying rentals in the winter? Joe? Finding a tenant. Is it easy to find a tenant between Thanksgiving and Christmas?
It was this year.
Yeah, it can happen. There are guys looking out there, but typically, do you see increases in rents? Are you getting top rent dollar between Christmas and New Year's? No. Right? You tend to get the lower one because you have to lower the bar to get somebody in because you don't want to have vacancy. So it's a little bit better to buy in the winter, but not the best time to rent. So what's one of the solutions? If we're going to buy a property in December, are we going to lease it for a year so that it comes due again in December? No. What are we going to do? A 6-month lease or a 18-month lease? We're going to try to get on the cycle. So you're going to try to have it coming on, whether you decide the cycle is April or May or June or August, whatever it is that you feel is right, you want to kind of stagger it so that it works. Okay.
What's the other downside to buying in the winter?
What's the other downside?
Less selection.
Oh, yes, right. Good point, Tam. Yeah, so basically, the downside of buying in the winter is there are fewer properties to pick from. So funny.
It was like a trick question for Tammy.
I was like, what's going on? What else? I thought she was like, you drag snow in the house, you can't wear your Crocs.
I was like, she's gonna have a funny joke.
I was like too. I was like, yeah, I can't wear my Crocs. Is that what you're getting at? I don't know what's going on. Yes, lower inventory, because there are fewer houses for sale, so you have a smaller selection. If you want to go in the summertime, you have a larger choice, but there's more people competing for that property as well. Okay. Actually, it's right here. So which gives us more choices? We talked about that. Which gives us more competition? We talked about that. There are more people looking. What's better for nomads? More choice or less competition? Depends, right? I think you do whatever works best for you, and if you can, maybe you live in a property for 13 months or 14 months to get on a better cycle as you do it. Better to buy a property, though, right away. Don't wait till the summer to do a deal. Okay, in our market, if the market's going up 10% and you wait 6 months, you just paid 5% more for a property than you may not have needed to, which on a $300,000 property is $15,000 for waiting. Is this different for other types of investors? What about fix and flip, buy and hold, or creative investors? If you're trying to buy something for fix and flip and you're able to buy it in the wintertime and it takes you 3 months, 4 months, 5 months, 6 months to get it on the market to sell, isn't that good? You buy it in November, you're putting it on the market in April? That's like ideal. So for fix and flip people, be buying these properties during the holidays. That's a great time to buy. Now, just the opposite happens though. If you're buying in the summer, guess what? Your property's going up for sale sometimes in November or December. Less than ideal. Take that into account in your numbers. Okay, buy and hold, we talked about that a little bit. What about creative? Anybody in here doing off-market marketing, buy creatively? Okay, so what about it? Seasonality. What time of year? Is it different? Do you get more calls in the winter?
I don't know. I get more desperate calls in the winter.
I was agreeing with you. So basically, when you get calls in November, December, you get fewer calls, but the ones you get are more motivated. Okay? So when you go out there, your percentages of closing are usually higher. Because someone who's willing to call you on a deal in the wintertime is usually a little bit more motivated. So if you're doing creative stuff, you'll spend more money on marketing, you'll get fewer calls, but you'll have to go on fewer appointments to get more deals. So it's still worth doing. All right, new listings. This is monthly. Yes, this is monthly. So all the data is same things, number of listings per month for the 4 different cities to give you a feel of how many listings are on there per month. You can see there's some seasonality going on, but that's just the same chart we showed before, just different frequency of data. Number of listings year over year. So one of the things I'd like to do is show you how the data compares for this year to last year to the other year, sort of like superimposed on top of each other. And so this shows you the red line is going to be the number of new listings in 2017. By the way, this is January, this is December, so each one of these is a month. So basically in January we have a certain number of listings, about, I don't know, 150 or so. And then here in the peak we have, I don't know, 350 or so. And then over here we've got a little less than 100. So you can see the number of listings increases over the summer and goes down. The red line is 2017 numbers, each month of listings. And this is, by the way, is Fort Collins single family homes. And the green line is 2016, the year before. The really faint lines that you guys in the back probably cannot see, but the people smart enough to sit in the front can see, are the really faint ones, are like 8 other years of history going back. So 2014, 2013, 2012, so on and so forth. They're not labeled, but you can get a feel for how we compare to other markets. And you can see that 2016 numbers, 2 years ago, lower number of listings in Fort Collins than we see in 2017. We have slightly more in all months. Remember I told you Greeley was a little bit weird? We're going to get to that here in a second. But Fort Collins, you'd expect it, right? We had more listings coming on, so for almost every month we saw more listings in that month. It's pretty evenly distributed. Any questions? Here's Loveland. Pretty even. There were a couple months where you saw a pretty big difference. This is 2017, a lot more listings in May than we saw in Loveland than we saw in previous years. In fact, this is a new high compared to what we've seen even in like the back 10 years. Then we see kind of pretty even, close together, and down there trend. This is Windsor, less property, so a little bit more erratic, but we're starting to see a small increase, a lot of red above, but a couple months where we didn't quite have as many, a little more above. This is Greeley though. Greeley's a little wacky. So slow to start. In 2017, we had a lot fewer listings for the first, I don't know, 7 months of the year till July. Then it actually looks closer to what we've seen in the other cities. So Greeley, even though Greeley as a whole, the number of listings were down, it actually got more normalized as the year went on. If you didn't look at it this way, if you just looked at the number of listings, you'd think, what's going on with Greeley? Maybe I shouldn't invest in Greeley. Where I look at this and I say, there was something going on with Greeley. Now, not so much. Now it looks much more like it did in the past. Does that make sense, everybody? Okay. So closer in sync to 2016 than 2017. Yeah?
Do you have any theories as to what was happening at the beginning of the year?
I do not. No. I'm becoming more and more friendly with Greeley, but we haven't gotten that close yet where it's confided in me what was going on earlier this year. Let's go look at it. I didn't look at that data, but I have it up here in a chart. We'll show it. We'll show price and price per square foot. So when that comes up, definitely ask me. All right, so to save you time, you're welcome. I'm not going to show you the weekly versions of this, although there are weekly versions of it. So clients, if you want to go see those, you can go look at the weekly version and say, what's happening with inventory? Are we seeing an increase in market? What's been happening? So you don't have to wait till the end of a month or the end of a quarter. You can see almost real time what's happening. Okay, new listings for multifamily. So we're going to take a look at how many duplexes, triplexes, and fourplexes there were. And then I'm also going to show you a chart for 5 units or more. And I kind of wrap those all together because 5 units or more is commercial loans. So if you want one of these, how many people want a duplex, triplex, or fourplex? Or a bigger unit? Okay. So if you want one of these, this is like the number of chances you have in any given year in order to find one. Yeah, it's like how many of these opportunities are going to come up. So when you see one come across, you're like, you know, it's close, but I'll just wait for the 37 or 50 more properties that I think are going to come on at the end of this year. You may not see that many. We're going to show you the numbers. Remember, nomads can buy duplexes, triplexes, or fourplexes with VA loans, nothing down, or FHA loans, 3.5% down. So you can buy duplexes, triplexes, or fourplexes with these low down payment options where you live in the property, you live in one of the units. Okay? There's also a just as a side note, not related to this slide, there is a new 0% down loan program for single family homes for first time home buyers. That is not VA, not FHA, or not VA, not USDA. Okay? So that's a new option that is, I just learned out of it like over Christmas. No, I think it's a portfolio product. Yep. Yeah. So kind of new stuff that we didn't have before, so it's a new option for you. Okay. And you have to have it's only for first-time home buyers, and they have to own or occupy. Nope, this is single family only. So you can do 0% down for VA for those, for a duplex, triplex, or fourplex, or 3.5% for those. Otherwise, it's going to be 25% for duplexes, triplexes, or fourplexes for investors if you're not owner occupied. All right, so number of duplexes by year, and I show you a whole bunch of other cities just in case you're thinking to yourself, but James, you're stacking the deck. You're not showing me about Wellington or Berthoud, and I know there's a million duplexes for sale in Wellington, right? So I'm not trying to stack the deck. I'm showing you all the different cities. I'm going all the way back to 1997. I'm showing you the number of duplexes that are for sale in that given year for every different one. So if you wanted a duplex, your peak year was Greeley in 2005. You had your choice of about 70 different duplexes that came on the market. So if you wanted maximum selection, Greeley in 2005, use your time machine, go back there and buy a duplex in 2005. Okay? Last year, 2017, the biggest number of duplexes for sale was Fort Collins, I think, which was about 30. So 30 duplexes came for sale last year in Fort Collins. Then the next biggest one was Greeley, I don't know, 22 or so. The next one after that is Longmont. Next one after that is Loveland. And then a whole bunch of like onesie twosies down there for all the other cities. So if you wanted to buy a duplex in any of these cities, you did not have a lot of options. And having looked at the overwhelming majority of them with clients, the duplexes in Fort Collins were mostly overpriced. And I'll show you some charts on that here in a second. Okay? Any questions on Fort Collins duplexes? Can you see inventory is way down from what it used to be? It is hard to buy duplexes in Fort Collins or other cities in northern Colorado. That's true, but there were more choices. And the prices were much more reasonable. I'll show you a chart on that. Yeah, Anna. Oh, yeah. Yeah, totally. And I'll show you data on that too, which is crazy. Yeah, and there's another chart somewhere, or at least a slide later on, where I talk to you about we're seeing pressure on cash return. So we're not getting the cash flow we're used to seeing on properties anymore, although that has been a trend for a long time. But there was a period when we were able to get slightly better ones. Okay. What about I want a triplex? Instead of doing duplexes, you say to me, okay, duplexes, yeah, I understand. There's not a lot of those. But triplexes, there's a ton of those out there, right? No, fewer. So basically, this is Greeley. Greeley looks like, I don't know, 8 or so last year. What is this? Longmont, 6. Green ones, Fort Collins, they're about 5. Whatever this is. Wellington, you've got 1 or 2. There's not very many. So there's a really small number of these triplexes for sale. So if you want a triplex and one comes along, what do you need to do? Got to be aggressive. Got to be super aggressive if you really want one. Now, I wouldn't encourage you to be aggressive unless the numbers make sense, but if you really, really want one of these, that's the option you have. So where are the nomads that are thinking, I wanted to buy multifamily? Raise your hands. Okay, so nomads, multifamily comes up. Do you wait for a multifamily, or do you say, if a single family home that comes up that makes sense, should I buy that? You buy the single family home, even if it means you don't buy the multifamily. Okay, what about fourplexes? Same idea, very small number. This one is, I don't know, 6, and that is Loveland maybe. Then you've got Greeley and what's red? Evans or Timnath, one of those two. And then you've got Wellington or something, or Fort Collins. So there's really not a lot of these, 5 or so. Okay. Now, what's special about duplexes, triplexes, or fourplexes about financing? It's conventional financing. You can get 30-year fixed-rate loans. Once you go to a 5-unit or greater, all the financing rules change. So if you want to go do that, you're probably not moving in, and you're probably not getting a 30-year fixed-rate loan, though there are exceptions. Most of it's portfolio. So if you want one of those, these are everything above 5 units combined. Not exactly 5 units. This is there a 20-plex available? Is there a 30-plex available? Is there a 10-plex available? Is there a 5-plex? All of these are combined. And you can see there's nothing over 8 in any of the cities.
You're only pulling from the MLS, right?
I'm only pulling from the MLS.
That does matter.
It does matter, but there's not a ton on LoopNet or stuff.
It's not going to be 100. It's going to be like 16 instead of 8.
And maybe not even that. And it's usually the big ones that are going in there. It's not going to be the 5-plexes or the 8-plexes.
Asking you to speculate, but do you know how many properties are changing hands that don't hit the MLS?
Yes, I actually do know that number. What was the number? I think it was 3% of properties are off market, don't hit the MLS. So that's about what the rule is for properties. And that was based on, a few years ago, I actually pulled up, and by the way, this is also anecdotally backed up by title companies, but I pulled up data. I said, okay, tell me the number of transactions, sales that actually happen in public record data. So you can go look at that, and I pulled all that data out there. And then I said, show me how many sales occurred that were in the MLS. And I actually compared the two numbers, and there was about 3% differential between them. Then I went and I asked title company, I'm like, since you guys would still handle the closing for a lot of these things, even if there wasn't a real estate agent involved, for sale by owner, the seller gets together with the buyer and they go to a title company, so they're going to get title insurance and they need someone to hold the money and stuff like that. So you go to a title company, you say to them, how many transactions do you have that is not accompanied by a real estate agent? And they tell me 1 out of 20, 1 out of 25, somewhere in that ballpark. So anecdotally, it matches up. Okay? Good question. Yeah.
Did FISBOs hit the MLS?
Nope, they do not. By definition, they are for sale by owner. They do not hit the MLS. Yep. If they're listed in the MLS, they're a limited service thing if they're just getting a MLS listing. And so they would not be considered for sale by owner. This is included. Yep. If it's in the MLS, I have data on it. Yep. Yep. Okay. Any questions on that? All right. So new listings, HOA. So sometimes investors say to me, hey, listen, I want to buy a property and I hate HOAs. The idea of paying $100 a month or $150 a month to an HOA, it doesn't make any sense to me. Let's only go look at properties that are available for sale that do not have HOAs. Let's see how many there are. Are we seeing more homes with HOAs being sold? Yes or no? Yes. Are there still homes we can buy that don't have an HOA? Yes. What cities are most likely to have properties without HOAs? Let's take a look at data. Oh, as a side note to this, the stuff we're going to talk about HOAs, we're seeing a trend. We're seeing new subdivisions, instead of putting HOAs in place, which show up on my charts when I do search for HOA and non-HOA, they're putting properties into metro taxing districts, and the metro taxing district is acting like an HOA, even though they're not technically an HOA, nor is it listed in the MLS such. So you're going to go and buy a property, and you're going to go and say, hey, look, there's no HOA fee on this one. Let's go buy this one. You go there, and the taxes are 50% higher than they were than another property you're considering. Okay? That's the metro taxing district. And they're acting sort of like HOAs, but they are not HOAs.
So are the metro taxing districts, do they also tend to be covenant governed like an HOA?
Yep.
But can't you write it off, though?
Sure.
That's
Sure.
the advantage of it.
Yeah, that's one of the advantages they try to tell you about. Yeah.
What are you getting for your money, though?
A lot of the benefits that HOAs do, like covenants and common area maintenance. In some cases, they're including water. In some cases, they're not. Trash. Yeah, things like that. Yeah.
Why avoid properties with an HOA?
So a lot of investors avoid properties with HOAs because they don't want to pay that extra $50 or $100 or $150 a month because it impacts cash flow. So it's hard to make a property profitable when you're paying an extra $150 on top of your normal monthly payment and maintenance and expenses on it.
Is that not offset by the upside of HOA, keeping a nicer neighborhood?
So some would argue that part of the fee that you're paying to the HOA can reduce the maintenance number you use in your maintenance account, or some of the benefits like garbage or water or something like that. But what tends to happen is the HOAs are not efficiently managed such that you're paying a small premium for that, so it's not like a great deal for you to do it that way. Like you would be better off paying your own maintenance because you're going to shop around and get the best deal and kind of optimize your thing. You're not going to say, let's all do new roofs right now, even though 4 of the buildings don't need it. Make sense? So
The maintenance thing really only applies to condos and townhomes.
that's true.
Right? I mean, most of the HOA fees for other stuff
like enforcement of covenants and yeah, pool or something like that.
Boat outside,
Yeah.
pools are a big deal.
Yeah. Yeah, the challenge is you don't always get the benefit of the HOA fee, and you're not able to charge it for rent in a lot of cases. And that's been the big issue.
And they're getting very anti-investor right now.
Depends on the HOA. There are some that absolutely are, and there are some that don't care.
We have two HOAs that get anti-investor.
Like they
Yeah.
they put in the covenants you can't have rentals or.
You know, we have to like, when we do it, when we renew our lease, we have to like send our lease to the HOA.
That's pretty normal though,
Yeah.
especially in condos and townhomes.
Some are not. It really does depend on the HOA, because certain ones are and certain ones are not. And there was a time, there was a push, it's probably a decade ago now, there was a strong push where HOAs were trying to limit the ability to even sell properties. Like there were HOA covenants, you remember this, where they were like not allowing yard signs and they were having enforcements of that stuff? But we don't see that anymore. I mean, have you come across any HOAs that are like trying to enforce you can't have a yard sign saying that you're selling your property?
There's a few that won't even allow you to have a sign in a window. It just kind of depends on the complex.
Yeah, but there was a time when that was a growing trend. And I think there was so much pushback on that that it just went away. Yeah. All right, so I want to talk about that. So here's the charts. People want data. So this is Fort Collins. The red line is properties without an HOA. So back in 1997, a lot of properties without HOAs. And then there was a trend where HOAs started increasing or people started entering in the MLS. Could be one or the other. And then we saw actually a pretty steep increase where now most of the properties that are selling have HOAs. And it's increasing. This is the number. Okay? So you can see that trend. This is the same chart for Loveland. Again, the red one is no HOA. And then the blue one is the number with HOA, and you can see that. And then this one is Windsor. You can see Windsor is a big increase in the ones with HOA. That's a lot of the new construction that we're seeing there. Almost all the new construction, it's extremely difficult. I don't even think I can think of an example of a new construction neighborhood that does not have an HOA. So if you guys want to decide to become builders and build subdivisions though, maybe you want to make an HOA. Keep collecting money as you go, kind of skim off the top, whatever you're doing there. But basically, that's the idea. A lot of the builders, I think, are storing HOAs and they're keeping a little bit of profit there. And then finally, this is Greeley. So Greeley, a lot more without HOA. In fact, they're pretty close. So Greeley is probably one of the best cities of the four that we're going to cover about not having HOAs.
And many of the HOAs in the newer neighborhoods are very low cost HOAs.
Yeah, $25, $35 a month.
Or like $150 a year, right?
I don't see a lot of $150 a year anymore. They used to be. I think they're closer to like $250 a year, $300 a year. It's $500 now. See, they're going up. And actually, the new ones they're actually doing metro districts.
But then they have the water fee.
Yeah, and they're doing water. Water's becoming a big deal. All right. So number of homes sold. Fort Collins, 3,000 in 2016, 3,144 in 2017. We're up 4.2% for number of homes sold in Fort Collins. Loveland, 1835, we're down 1%, essentially the same in my opinion. 1816 in 2017. Windsor, 879, down 2.6 to 856. This is really mild in my opinion. Greeley, 2,064, down 16%. That's pretty substantial. To 1,734. Okay, that's the number of houses sold. So before we were talking about number of listings, now we're talking about number of ones that actually sold from the MLS. We're talking about this. Okay, so basically this is the same type of charts. I'm going to fly through these because we kind of covered a lot of this. This is the number sold. I think this is by quarter. So you can see the different quarters going all the way back to 1997 through 2017 over here. You can see the number of properties that sold in any given quarter for the four different cities. To get an idea, the biggest one, Fort Collins is the largest. Loveland and Greeley are similar in size, and Windsor is tiny in comparison, although Windsor is increasing. All right, and then number sold here, this is the same chart, just zoomed in. I think this is monthly now, same type of a data. Oh, so 3 months ago, 2 months ago or so, I actually changed web servers for your benefit. Actually, most of the server is faster. However, when I moved to the new web server, some of the configuration settings on the new web server don't work the same as they did before. One of the features is that it stops loading the page after a certain amount of time. And some of my software that I wrote to provide the charts for you was not optimized because I'm a realtor, not a programmer, as some people snicker in the back of the room. So I have the chart data for you, but this was one of the charts that was lost by moving to the new server because it's too big to load on the new server. So this is the last time you'll probably see this chart unless I go and program it again. So look at all the pretty things. It's not updated since 2016. Okay? All right, average sold price to list price. So this is the one where we start talking about properties listed on the market. Are you able to come in low? Are you able to lowball? Or how much above asking price do you need to bid in order to get the property or offer accepted? This is where we start talking about that. So Fort Collins, in 2016, the average was you had to spend 100.54% of a property in order to get an offer accepted and sold. So if a property is listed for $300,000, you had to make an offer for $301,500, if my math is correct, in order to get that property offer accepted and sold. That's what the 100.54. 100 means you had to basically list price. If it's listed for 300, you need to offer 300 to get it on average. Okay? In 2017, you didn't even need to do list price on average. 99.71. Really, really close, maybe $500, $700 off, but basically most of the properties are doing that. So the market was less hot in 2017 than it was in 2016 is another way of thinking about that. Yeah, Josh?
This does or what does not factor in concessions?
Does not. I'm going to go into a slide on that, and I'm going to go into like excruciating detail. This is big picture, then I'm going to drill deep.
Are you going to talk about how averages are accepted?
Oh yeah, I'm going to go and show you percentiles. I'm going to go to Freaky Town. Yep. Yep. Any questions on like the big picture of how this works though? We're seeing the market softening the slightest bit from 2016 to 2017 in Fort Collins, which anyone who bought properties in 2017 may have sensed, right? You sensed it was a little less hot than it was the year before if you bought properties in both years. Loveland went down a little bit too. It was 100.17, now it's 99.88, not a huge difference. Windsor was 99.69, stayed about the same, 99.73. Greeley was 100.22. It's now down to 100.16. So slightly down. Okay. So this is sold price compared to the last list price. So someone comes on the market, they list the price, they list the property, you're like, hey, listen, the market's really hot. Mr. or Mrs. Realtor, what I really want you to do is let's try 350. I think we can get 350 for this property. You know, I had an appraisal done last week, came in at 300, but the market's hot. Let's try 350, see what we can get. They list it for 350. They don't get any offers. They drop the price to 340. No offers. Drop the price to 330. No offers. Drop the price to 310. They get an offer for 300. They now accept that offer. Now it looks like 310 was the last list price, and it sold for 300. So whatever that percentile difference was, it was 3% or whatever it is, now it looks like that sold for 97 point whatever percent it was of list. Of the last list. So it's basically last list price to then sold price. Another thing that could happen. So let's say someone, same example, someone started off at 350. They go down to 340, they go down to 330, they go down to 320. At 310, someone makes an offer at 310. They go under contract, they go have their inspection done, and they're like, you know, this thing needs a new roof. I'm going to come back in and I'm going to get them to make $10,000 concessions off that. Now all of a sudden they've renegotiated the price once it's under contract. It was listed for 310, they offered 310, and now they actually have an offer, they basically have a sold price of 300. So the percentile is again 3% down. Does that make sense? Even though it was listed at 310 and they negotiated after the fact. So it's after changing price after, oh, let me talk about this. So let's say somebody had a property that was listed for 310, they make an offer for 300, they accept the offer for 300. And the agent says, hey, listen, let's go ahead and change the price in the MLS from 310 to 300 so that it's listed for 300 now, and now it's at list price. Now it looks like an offer at 100%. Okay? And it works out even worse when you're in the other direction. So let's say it was listed for 300. 9 of you decided you wanted it. You all made offers. It sells for 305, $5,000 above. The agent comes in and says, well, obviously it was worth 305 because we had multiple offers at 305. So let's go ahead and raise the list price up to 305. When the appraiser goes out, they're going to see it was listed for 305. We have an offer for 305. Let's just make it 305. Now all of a sudden that one shows up as 100%. Does that make sense? Yes. Okay. So we discussed changing price after it's under contract, after negotiating for inspection and appraisal. So let's say it doesn't appraise, you have to negotiate there. It includes seller concessions. So basically if the seller includes contributing $2,000 toward concessions, that is not taken out of these numbers. Yeah, Brian.
So Mr. Godfather, how many realtors actually care about their stats of sold to list price?
I think there are probably a good number that do, because I think some of them use it when they go and they sit down and make a presentation to a seller about, I get, 101% of my average, list price or something like that.
That's what I achieved.
Yeah, I think that some of them would lead with that marketing stat. I don't know. I don't lead with that, but I think there's some that do. Yeah.
Is it a fairly common practice?
I don't know. What's your feel on that? Do you think a lot of agents are worried about their list, the sold to list stats?
We don't.
Yeah.
So I can't speak for that.
I think there's a certain percentage that do. I don't know if it's like 80% of agents, but if I had to guess, just pull thing out of my butt, 25% maybe. I think there are some that do, especially ones that are trying to use that as a stat that they're going to compete against.
I think that's a stat that's more relevant in a really hot market. As the market cools, you just don't have that great of a stat to be like, oh, I sold for 105% of list price.
Well, it might be the other direction though. I sell for 99% of list price. If you're getting offers that are lowball, yeah. So I can see that being used, but I don't know if it's like 75% of the marketplace. And then price changes. We talked about that. This is average again, sold price to list price for each year, and then start thinking, this is average. Are we going to be wanting average type properties, or are we trying to find great properties, above average properties? Yeah, above average. And so those tend to be higher than that. We're going to dig into deeper. Anything above 100% are selling for above asking price on average, and then a 1% above asking price. So if it says 101, that's a $300,000 property for 303. So you did $3,000 above for a 1% differential. Okay, so let's take a look at the chart. This shows you all the cities combined. This is 1997. Back in 1997, they're all clustered really close together. Most properties were selling for, on average, about 98.5%. So you're getting about a 1.5% discount on average on properties in the MLS in 1997. It actually went up so that in, 2001 or so, it was probably close to 100, 99.5 or something like that. Then it started declining, and we saw our low back in 2008, 2009, where people were getting, I'm just going to eyeball it here, 97% of asking price. So on average, people were getting about a 3% discount. Does that shock anyone that it was so low? That it's only 3%? You think, oh, this is like the worst real estate market of our lifetime. And people were only on average getting a 3% discount.
People were probably being unrealistic at listing their price.
Agreed. Yeah, because part of it's what you list it for. Yep. Okay, so this is the low. And then it's kind of worked its way back up. And we had a couple years near where it was kind of above 100. This is the 100 line. So we had some stuff here where it was above 100. In 2017, though, about 100 for all those. But you can see the long-term trend. Okay, this is same data except zoomed in, so you can kind of see some seasonality. But do you see that during the summer months, we tend to get above asking price offers, more of them, and during the winter months, we tend to get a little bit lower than that. Right? So here's 100. You see some seasonality during the summer. Summer, summer. Make sense? So if you're buying a property in the winter, just on average, and every property is different, but on average, you have a tendency to be able to come in a little bit lower. Less people shopping. Yeah?
Is that true of buying new construction as well?
No. New construction, my experience with them has been list price is list price. Have you had a different experience? No. Yep.
Will they change their list price in the summer? Will they move it up?
They'll move it up faster. They'll move it up faster than they do in the winter. So they may set their price in September and just not increase it again until February.
It depends on how fast they're selling.
Agreed.
Really, if they're
Supply and
selling
demand.
faster, they'll increase their price more quickly, maybe more houses.
Yeah.
If they're not selling, they'll throw in some concessions and extra refrigerator.
I agree. I think they're more likely to throw an AC or a refrigerator than they are to adjust price. Because if you think about it, they don't want their neighbor to be all pissed off, oh, you paid $300, I only paid $297, and I bought mine after yours. They'd rather say, hey, they throw in a refrigerator, it was a special Memorial Day weekend or whatever it was.
Well, plus their cost.
Right. Yeah, they'll have appraisal issues as well. Another good point. Yeah. Okay? So seasonality, talked about that. Sold price to list price percentiles. This is going to show you some percentile charts, and I'm going to go to Freaky Town. So I'm going to show you some things where I'm going to say the 5th percentile or the 95th percentile. So the 5th percentile means one property in 20 sells for what premium above list price. So one property in 20 is going to sell for this amount or more. Okay? The 95th percentile says one property in 20 is going to sell for this percent or less. Okay? So I'm going to show you what this means on a chart. This is Fort Collins, single-family homes, detached homes. This is 1997. This is 2017. 2017, the median, 50% of the properties, half of them sold for above this, half of them sold for below this, is about 100. This is the 100 line. Okay? These lines going out show ranges of values. So for example, this little faint line that you guys can't see in the back, you should sit in the front next time, basically right here in 2017 means that 1 in 20 properties sold for a 5% discount from list price or more. 1 in 20 sold for 5%, sold for a 5% discount or more. Then up here, 1 property in 20 sold for almost 5% or more above asking price. That's what these end lines are. And then if you come in a little bit, the little darker line, this is the 10%. So 1 property in 10 sold for 4% discount or more. And then 1 property in 10 sold for a 3% premium above asking price or more. And that's what this chart shows. It shows you all those different percentiles and how much, what the likelihood of selling a property for this percent or more means. Does that make sense? This is, by the way, this is a slide where I won 100 burritos on. I thought I won 100. So what was the bet? It was like 100 burritos. It was one.
Before you go, sir. You can't make that joke anymore because you've used it 100 times. So
I used it 100 times, one for each burrito. Okay. So everyone understand what's going on? You can see sort of the trend and how wide the distribution is for that. So that's Fort Collins. This one is Loveland. So, whatever it is. Back in 1997, the average was about 99 or so, 99.5. This year it's about 100. 1 property in 20 sold for 5% above, and 1 property in 20 sold for 5% or lower. So similar stats to what we saw in Fort Collins. This is Windsor. 1 property in 20 sold for about 4.5% or above, and then 1 property in 20 sold for about, 4.5% below. So similar for Windsor. This is Greeley. 1 property in 20 sold for over 5%, 5.5 almost, maybe 106. And then 1 property in 20 sold for a 5% discount. What's interesting though is what happened in 2008. 1 property in 20 sold for like a 13% discount in Greeley in 2008. That's what this shows, that you had this stretching down. And not a lot of properties, although I guess it is quite a few properties. So 1 property in 20 and back in even 2008 sold for almost 4% above asking price. So even because you had a lot of stuff get lowballed. That's why this thing. You do. That's what I was just going to say, is that even during the worst real estate market of our lifetime, there were some properties in Greeley that were still being bid above asking price. Crazy.
Short sales affect these. Short sales.
Yeah, short sales are in there too. So basically, if it was listed for 300 and it sold for 270, that counts as a 10% discount.
Sometimes those above asking price could be that the builder has their base price.
Agreed.
And then when it sells, it's like all the add-ons and options.
But you would need to have a very large number to have it be 1 in 20.
It's not all builder stuff.
Agreed.
I would imagine that there were investors that were looking at those prices going, yeah, I really want that house. Or I really want
Right. And I'm willing to pay a premium.
pay 105% because who cares? It's down from where it was.
Right. And the list price could have been already under market.
Right.
Yep, I agree. Totally agree. Okay, so I've taught at least an hour long, if not an hour and a half class on this one next slide alone. You're not going to get that tonight. But do take some time to go through it and do this. And this is basically sold to list price in a weekly version. It is just single family homes, and it can be used to determine how hot a market is. So we just looked at some of this data here, and we see it on a yearly basis. But if you're in the middle of a year and you're like, okay, I'm about to go make an offer, are we seeing a lot of people make above asking price offers? And how much are we seeing them make above asking price offers? Are we seeing this trend? And is the trend different than 2 weeks ago or 3 weeks ago or a month ago? And so you need more finely tuned, more frequent updating of data to do this. Okay? So we're going to do monthly. Or we're going to do weekly to do that, to see more frequent change. And the question you're going to ask me is, why not do daily then? And I say to you, there's a 7-minute ab exercise routine. Why not just do 6 minutes? Right? Why not do 5 minutes? So the point is you get to a point where you have enough data that it becomes meaningful. If it starts going daily, it starts going all erratic. Even weekly it gets a little bit erratic, okay? But it helps you understand what's going on, and so it's just this reasonable amount of measurement. I think a week is a reasonable amount of time, and so we're going to do that. You can also see some seasonal trends. So I could spend like 2 hours on this one chart, but basically the blue line is 2016, the red line is 2017, and you can see that in 2016, there were some parts of the offers were coming in at below asking price early in the year. This is like the first couple months. And then you have stuff coming in later in the year, September through December. It's all below asking price. But over the summer, there's much more stuff above asking price. And so you can see the overall trend is it starts off low. In the summer, it peaks out, and then it comes back down. And the trend holds true for both years, 2016 and 2017. They're built on top of each other. But I will show you the red line is 2017. We saw less ups over the summer than we did in 2016. So fewer people having to bid above asking price than we did in the year before. And the lows were a little bit more reasonable too, because in 2016, people were able to come in lower here. In 2017, they were lower here than they were in 2016. Okay? Does that make sense, everybody? But this is a really important chart, especially if you're mid-year and you're about to make an offer, being able to look at historical data and say, are we worse? Are we hotter than we were last year? Or are we less hot? Are we having to come in above asking price? And these other lines, like I showed you those percentiles before of 1 in 20 or 1 in 10, that's what all these show. And it compares year over year, so it kind of overlays them. And when you're on the website and you're toggling the charts, you can toggle these on one at a time to see how they compare to each other. Okay? Okay. Oh, by the way, this chart didn't work on the new server. So I had to write new code, new chart. You're welcome. Smiley face. That's from Brian. Okay. Here's another interesting way to look at this. This, again, is sold price to list price versus list price. So what it does is it takes the ratio of how much I need to bid above or below asking price, but I'm showing you how it compares to low price properties to high price properties. Here's the question for you. On properties that are priced $150,000 to $200,000, are we going to have to bid more aggressively above asking price to get those versus a property that's $1 million? Yes. And so that's what this chart shows you. It shows you each one of these dots is a transaction for last year, and shows you the dots that appear above this 100% line are properties that had to bid above asking price for. The ones that are below, you had to bid below asking price. This is the cheap stuff over here. Here's $100,000 properties. And then this is $900,000 properties. And so the cheap stuff, there's more mass above the 100% line. And then it gets lower and lower and lower until you get to the more expensive stuff where properties are selling for bigger discounts. It's what you'd expect. I just proved it with data. Okay? The lines in here are going to show you medians and averages for those ranges. And I just zoomed in and got rid of all the clutter behind you to show you this. But this is pretty interesting because what it shows you is the red line here on top is the average 12 months ago, so a year ago, and then this one is the average for last year. So one of them is 2016, the other one is 2017. This is 2016. People were having to bid higher, especially for the lower end stuff. This is the low price. This is the higher price stuff. So you have this huge amount of bidding above asking price, and it gets much closer as you get higher up here. So the bigger discounts did not apply to the high end stuff, but you had to bid much higher for the low end stuff 2 years ago than you did this year. And then the other one is median. Same thing's happening. Does that make sense? Market is less hot in 2017 than it was in 2016, and that's what this shows. And for those that are clients, I have charts that basically do a rolling 12-month back average for this same data. So you come on here in March, you don't have to use a year ago data. It uses 12 months prior, and it compares it to the 12 months prior to that too. Okay? Yes?
Days on market for the lower end one versus the...
I'm so glad you asked. I have this exact same chart, except down here, instead of price, I have days on market. I'm going to show it to you. It's in there. I think it's coming up soon, where we get to days on market stuff. Yeah. It's what you think it would be, though. Any questions on this? Kind of cool? Nice. All right, so this is, again, 4 columns sold list price. I'm zooming in to show you, oh, this is days on market for you. So this is basically the percentage of how big of a discount or premium you can get based on how long it's been on the market. So here's the question for you. A property just comes on the market. can you come in and lowball them and give them 20% below asking price? Are you likely to get that offer accepted? No. What if a property's been sitting on the market for half a year? Are you more likely to be able to get that accepted if you kind of lowball them 6 months from now? Yes. And so that's what this chart shows. Basically, this is the 0 days on market. This is a year on market. And so anything above this 100% line shows that people are bidding above asking price early on. And then as the trend goes down, as it's been on the market longer, people are actually coming in lower and lower. Yes, Josh?
What reasoning would you have for, something that's been on the market 300 days coming in at 100 to 110%?
I got a great example for you. Okay, property's been on the market a year. They do a $100,000 price drop. Whoops, we went too much. Now you have 7 people interested, and now they bid above asking price. And so then it can come in above asking price. Yep. It's not a good strategy, but some people accidentally find themselves in it. Yeah.
What's interesting is that there aren't that many above the 150 days on market that are actually, there's more lower ones in the first 150 days than there are after. And there's a smaller sample size, but it's coming from both ends.
Well, they also adjust the list price.
Yeah, you can adjust list price later on too.
Yeah, it's a hard chart. Like, looking at the first 100 days, maybe 150, it seems accurate. But then after that, people are,
Yeah, so this is a zoom going 0 to 90 days. Same data, just zoomed in now. And you can see each dot's a little clearer. There's a lot there. And I made a note here. It's much harder to come in low on properties just listed, which is what we're showing, although it does happen. Although it can also happen after it's under contract. You can have a reduction in price there. And then secondly, price drops occur when you're under contract too, so these might not all be offers accepted below asking price, even if they're at 100. Cool? All right. Does that answer your question about days on market? There's another chart coming up too on it though. I do this again. I ask someone a question and I don't even let them answer. I'm just like, oh, I'm going to answer for you.
anybody have any questions next slide?
Okay, exactly. Yes. Yeah. It drives you crazy?
You don't even look at people. You're like, does anyone have any questions?
That is true. That is probably, this is what I get complained about after dinner. So we go there, he's like, you do this all the time. Now he just complains in class.
We like to call it coaching.
Is that coaching? It's like management?
It's a coaching role.
Yeah. All right, average sold price. This is probably what you guys came for, except all the people that came for demographic data, which I don't have any of. So price. 2016, the average price in Fort Collins, $374.5. We're up 6.6% to $399.3. Loveland, $343.4, up 9% to $374.2. Windsor, $393.7, up 11.1% to $437.2. And then Greeley, $259.7, up 9.7% to $284.9. Now, want to point something out to you. Just because the market went up 6.6, 9%, 11.1, or 9.7, depending on what city you're in, it does not mean that your house went up 6.6, 9%, 11.1, or 9.7. James will not pay the difference.
You might take that deal as long as it goes both ways.
Oh, that's not working that way. I don't think that works any way I look at it.
I almost have.
Is this combined, like single-family condos?
Yes, it is combined. Yep, it's combined. So before Brian, I had separated out attached and detached, and I had to go through the presentation twice as fast, so I covered twice as many slides. Now I just combine them. But clients can break them out. They can break them out as attached or detached. Yep. All right, any questions on average sold price? So what I wanted to do is put both average sold price and the number of listings on the same page so that you can see the comparison, because we expected that when you have more properties for sale, it sort of suppresses price increase, right? You have fewer properties for sale, there's the same demand, pushes prices up. We would expect if you have more properties for sale that the price would actually be suppressed down. So Fort Collins, we had 3,488 increase to 3,834, went up almost 10%, and the price went up 6.6. So these are sort of working like unexpectedly in parallel. Okay, same idea.
In 0405, wasn't the numbers like 6,000 though? Listed a year in 0405?
We covered that early on when you weren't here. But yeah, there was a lot more listings.
And it was still increasing from whatever, 02 to 05 or 04.
Yeah, there was a peak in like 6 or 7, and then we started to see a decline in number of listings. We had whole charts on that. We already covered that.
But it's opposite of what you said logically would happen.
Right, this is what we're talking about. Yes, that's what we were saying before.
The logical thing also assumes everything else remains constant.
That is also true, and demand may have actually increased. Yes. Yep. And it probably does a little bit, right? We have basically this 11% increase here, and well, it's 11.11. Yeah. Yeah, but you would think that new construction coming on would suppress price, unless they were building bigger stuff. And then that would actually, you would expect an increase in price. Because size has an impact too. This is actually just price. When we do price per square foot, that is a better indicator, in my opinion. We're going to get there very soon.
Windsor obviously a lot more new construction, it seems like, and that price is much more.
Agreed? Yeah. All right, so one of the things we talk about when we talk about this thing, when you've seen me analyze properties and tell you what the overall return is, you've probably seen this chart before, but one of the things we talk about is the appreciation. And we say, basically you're getting, whatever the appreciation rate, we use a lot of times we use 3%, times a factor of 5 if you're putting 20% down, or times a factor of 20 if you're doing Nomad and putting 5% down. So take this number and multiply it by 5 to get your approximate return on investment from appreciation. So 6.6 times 5, if my math is right, it's like 30 something and change, 3.3 maybe, 30.3 or 33. And so you have a 30% return on your money if you put 20% down, or multiply this by 20, which is 120% return if you put 5% down, which is crazy. Do not use that in your modeling, but that's what we saw last year. Okay? Same idea here, and then 5% of cash flow and properties in the MLS. That's just my little note to myself. Okay, so this is average sold price per total square foot. So in Fort Collins in 2016, we're at 169 per square foot. In 2017, we're at 186. We're up about 10% of the price per square foot in Fort Collins. Loveland was 148, up 8.6% to 161. Windsor was 129, up 7.3 to 139. Greeley was 114, up 10.5% to 126. In my opinion, this is a better indicator for appreciation.
Does that include basement, I'm assuming, because it says
Total square foot, yep, so it's basements. Yep. So this is a much better indicator, in my opinion, because it normalizes for different property sizes selling. You have small properties selling, the price would tend to be a little lower. Larger properties, the price would be a little higher. This normalizes for that by using square footage. Any questions on that?
So Greeley's a better bang for the buck.
No doubt. Yep. Yeah, and this is a good way to kind of sort properties. Fort Collins is the most expensive. Loveland's the second most expensive. Windsor's the third most expensive, and then Greeley's the cheapest.
Well, and it also shows, like, the average sale price between Fort Collins and Windsor were pretty similar.
So they're larger properties.
But
Yep. So Windsor is building larger square footage properties, or they're selling larger square footage properties, another way of saying it. All right, so this is the same type of idea of chart from before. It shows you the percentiles of what the price per square foot is. So the blue line in the middle shows the halfway point. So half the properties are selling for greater than, above 155 or whatever it is, and half of them are selling for below that in Fort Collins. And then the bottom line here is the 1 in 20 properties is selling for about $120 per square foot, and then 1 in 20 properties is selling for $300 per square foot. Okay? That's what this chart shows. Shows you the range of all the different ones, so you can see what the percentiles are. This is the same idea in Greeley. This is the chart that Brian hates when I show because it shows the decline in Greeley, and he claims there's not really that big of a decline. Your graph is just kind of weirdly structured and stuff. And I agree with him because we did not see a huge decrease. But you do see a pretty big, what? I agree, your chart's that way, but it's like anecdotally, I felt, Greeley went really hard. But you can see the numbers here, and it shows you that there's an expansion there. So one property in 20, this isn't Greeley, one property in 20 sold for, I don't know, $80 a square foot, and then one property in 20 sold for $180 per square foot. So you can kind of see the range. Cool? This is all the same stuff. Sold property per total square foot. This is 1997. The one on top is Fort Collins. Fort Collins and Loveland used to be much closer together. It was like 75 and 74. Windsor used to be around, whatever that is, 71. And then Greeley used to be around, I don't know, 65-ish, somewhere around there. And then you can see they've sort of spread out, such that Fort Collins is much higher, Loveland, Windsor, and then Greeley. You can kind of see the different appreciation rates, price per square foot over time. And that's 2017. Any questions on that? This is just the same data with more frequent updating. I think this is either quarterly or monthly, so you can see a little bit more of what the movement is each month. One of the things I wanted to point out about this is you definitely see movements in price per square foot. If you made an offer, it's not like you can use this data, but in retrospect, properties were selling for a smaller price per square foot here than they were the next month. And you have ups and downs in month-by-month market. Can vary month from month. Remember, percentiles chart, this is just a zoom showing you that you have some variation here of pricing. Okay. Duplexes, price per unit. So remember before I told you that the prices of duplex has significantly increased? This shows you back in 1997, this chart would take like 2 hours to explain in detail, so I'm going to give you the summary. Back in 1997, prices for duplexes were really tight together here, and they kind of moved here, and then basically they got further and further apart and increased, such that here, there's properties that are listed for sale that are significantly higher than what we're typically used to seeing. It really skews it. We're seeing like an explosion of prices for duplexes from historical numbers. Okay? And this is normalized for price per unit. So it's showing you basically that now it's about $200,000 per unit on there.
So something sold last year for $750 per unit.
Oh, this one?
Yeah.
This one is a sold. Yep. Yep. Yeah. I don't know. Crazy. All right. That's duplexes. This is Greeley numbers. Very similar. You have some stuff here, and there's a lot more variation in duplex pricing in Greeley. And think about this. There are properties that are listed as duplex in Greeley where it's basically a house with a really, like a cellar second unit that they're counting as a duplex and listing. Have you guys ever seen these properties? You go out to Greeley, like the entrance to the property is sort of like around this like side door, and you have to sort of duck underneath and go down there, and you open up the thing, and it smells really damp, and you know it's that sort of duplex. And so you have some of the low end stuff, then you have really nice stuff. Okay. All right. So you can see all those. I probably should teach a whole class on this. If you're buying multifamily, this is probably one of the most valuable charts you could use. Brian's like shaking his head. This really is super powerful for being able to go and analyze what's sold easily. Mouse over this, it shows you the exact property and all the details on it. And you could toggle things on and off and see the range and what properties are selling for on a price per unit basis. It's really, really cool stuff for our clients that are doing that.
There was a point in time where we actually tried to use that data for a Loveland
To make an offer.
triplexes to actually
Justify an
show
offer.
the seller, like, hey, you're
Smoking crack.
way high, and then they just waited it out and sold it like 8 months later.
That is true. Yeah. Yep. Same stuff. I think I showed you Greeley already. So this is, before we were just talking about duplexes only. Now I'm going to show you duplexes, triplexes, and fourplexes all on the same chart, but normalized on a price per unit basis. So if there are 3 of them that sold, we divided by 3. If there were 2 of them that sold, we divided by 2. If there were 4 of them, we divided by 4, and it got you a price per unit. And you can see there's also a very wide range, and the prices are significantly higher than they've historically been. Okay? This is why it's harder to make the numbers work on duplexes, triplexes, and fourplexes in our marketplace. Any questions on this? I notice I speed up when I need to whiz. So like my presentations, I talk less on slides once I've drank like 9 glasses of water, and I know that I should not go to the bathroom while I'm recording you guys. All right, so with that being said, I'm sure you will. All right, Loveland ones, this is the same thing. Duplexes, triplexes, 4 units combined, normalized again. And you can see back in 1997, we have not seen as significant price increase or the crazy erraticness. That's why it looks more spread out. Whoa, that was weird. Just regular F5? That starts at the beginning. Zoom through. All right. What do you mean? Where did I have a smiley face? That's how we tell, like, who's wrote it.
You should have had a smiley face moving across the top, so when you fast forward through, it's like...
Oh, it like moves, like animates? I was going to show you something. Oh, I was going to show you this. So basically, yeah, when you have these really high data points up here where you have like outliers, and then you move to the next slide, you don't have those outliers, that's why the whole chart spreads out more, and you can see it. So if you're doing the other ones later on, you can actually exclude those and make them, look better. Yeah, so you can see the Loveland stuff. So Loveland duplexes are selling, duplexes, triplexes, fourplexes are selling for about, the sold median is $140,000 per unit. The ones that didn't sell on median were about $155,000. So the stuff that was listed but didn't sell is a little bit more expensive, which you'd expect. Here's Greeley numbers. The unit price per unit in Greeley was about $100K per unit, and that's up a little bit too. Okay, for the sake of time, I'm not going to go into a ton of detail. This chart, though, if you're ever like, someone says to you, but don't buy new construction because new construction, you're paying this premium for the properties, and it's a better deal for you to go buy resale properties or a property that's a year old or 2 year old. This is basically a new construction property, a 1 year old property, and a 2 year old property, and then all the resale properties that are greater than 2 years old combined, shown on one chart on a price per square foot basis, so that you can compare new construction to 1 year old properties, to 2 year old properties, to 3 year old plus properties all at the same time, and show that you are not paying a significant premium to buy new construction. And in some cases, they're actually better deals, depending on the year. But they're closer than you might think. And I do like probably an hour-long presentation on that. And this is Windsor because there's a lot of new construction in Windsor. I'm showing you that they're all really close together. So basically, the median of new construction and the median all but new construction are almost identical on a price per square foot basis, which is crazy to think about. You can get a brand new house versus a resale property when you're looking at those. Okay? All right, days on market. Where's my days on market people? They wanted this. So Fort Collins in 2016, 2 years ago, the average days on market was 70. Last year it was 60. Part of that was helped by there was a catching up of appraisals. There was a period of time in 2016 where we had a lot of delays for appraisals. Did you guys see a lot of delays for appraisals? Not this last year, but the year before.
Yeah.
Yeah. Now this year, everything got caught up. And so we didn't have to wait 45 days, 60 days in order to close. So we're seeing a lot of speeding up. So I think that's part of this number. So it's down basically 13% from 70 to 60. Loveland was 77, down to 66. Windsor 94, down 9.3% to 85. And Greeley 63, down 21.4% to 50 days on market on average.
But didn't last year it also drop too? Because I remember.
This is last year, yeah, 2017. Oh yeah, we're gonna show a chart right here. So basically, this is days on market going all the way back to 1997. So basically, back then it was ranging from 140 to 118 or so days on market for 4 different cities. It kind of moved around in here a little bit, but then it tended to go down starting around, I don't know, 2008 or 9. Things got hotter and hotter and hotter until they've all become really hot, except for Windsor. What's partially keeping Windsor inflated and higher than everything else? New construction. Properties that get listed as a brand new property, and they don't really care if that one sells. They just list it on there as kind of like a sample property, and it stays on the market for 180 days. That's helping bring that average up. Yeah. Yes, because they don't update that too. So no, days on market is basically it's the day it was listed for sale to either the day it goes pending or the day it goes sold. But pending is not used as much as it used to be. So people are keeping it active until the day it closes in a lot of cases. In that case, it would be the day it closed.
Right, because you have days to offer too. They actually list that.
We don't actually have that as an export feature. So the data is not available for export for that. If you want to ask Iris to start including it, I'd be happy to show charts.
So there's a lot of variability by the time it closes.
Agreed.
The time it goes under contract.
Totally agree.
Right.
Yeah. Yep. So you can see the days on market's kind of way down. Is that what you're looking for? Good timing. This is a zoom in, basically showing a little bit more frequency. I think this is quarterly or something like that, same data. This is a zoom in showing you monthly. What I want to show you is there's seasonality to days on market. We are seeing higher days on market during the winter months and lower days on market during the summer. Winter, summer, winter, summer, winter, summer, winter, summer. We're seeing that, okay? Which you'd expect. Okay, so Nick, what does that say right there? This line right here. Yeah, you have failed your eyesight test.
Just a question on that.
Yes.
One. On the monthly, is that the month listed or the month taken off the MLS?
It's been so long since I coded that, I'm not sure, but I think it's listed.
And the other unfortunate problem is you didn't comment the code, so you can't do that.
I could go look at what variable I'm using, though, and see what month it was. I totally can do that. But you're right, I did not comment that code. I mean, I haven't checked, but I'm like 99% sure. Okay, so this is going to show you the price range, different years. This is 2003, this is 2017, and it's going to show you the number of days on market. And it's color-coded so you can see visually. Red is really low days on market. Green is really high days on market, taking a long time to sell. So the higher price you get as you move down, you would expect it to take longer to sell. But then over time, this is earlier, 15 years ago or so, it wasn't as red. This is much shorter time as we've gotten more recent years, and it's actually gone further down on the price range. So higher priced properties are still selling faster than it used to be before. So you can visually see very quickly, this is really, really hot. This is really soft. And even up here now, it's not super hot, but it's hotter than it used to be historically, even for high price stuff. And this is 1 million plus properties down here. They're about $100,000 differences or so, and then there are $50,000 differences on the low end to expand it out. Cool? I really got to go to the bathroom. All right, so seasonality, days on market, shows you some seasonality, spring and summer. Months of inventory. So, months of inventory works like this. If you take the number of listings and the number of properties sold, and you put on a little Neil Diamond or Barry Manilow and the candlelight, and you say, boom, chicka bear now, and they got together, they would actually create the next statistic, which is months of inventory. It takes into account both the number of properties that were listed for sale and the number that have sold, and it figures out how many months it would take to sell the properties that are currently on the market for sale. Okay? I can show you the math, but for the sake of time, I'm not going to go into the math. I'm just going to tell you that it tells you the number of months it would take to sell through the current inventory that's on there. Okay? So this is showing you back in 1998 or so that used to have about, this is 4 columns by the way, used to have about, I don't know, 4 to 3 months of inventory at any given time. There's some seasonality as properties come on and stuff like that, and that it increased, got a lot more inventory back in 2004, 2005, 2006, 2007, 2008, but it kept compressing as 2010, so that down here in 2017, we had a really low days on market. And in fact, the beginning of 2017, we had, excuse me, an all-time low days on market here. That was like the lowest we'd ever seen it. It has since risen up and gone up here, but it's come back down since then, such that the days on market is not at the all-time low, but big picture-wise, it's still way low. How many months of inventory? Oh, I'm sorry, did I say days on market? Yeah, I got to pee really bad. So basically, the number of months of inventory, yeah, number of months of inventory. Yeah, it's like worse, like what do you now? Do you talk about it or do I just like keep pushing through? The number of months of inventory is really, really close to the low, but it is not the low. The low was probably last January or so when it was there. And by the way, this is all price ranges. If you are kind of curious, I was going to show you that. If you're all curious, I could break it down. You could say, look at the months of inventory of the 100 to 150 range or 300 to 350. You could do it for all different price ranges. They tend to track, but not all of them do. Yeah?
Just so everyone knows, if you actually get this chart up online, you can deselect or select any of those price stripes.
Yes.
It shows them, and it's way easier than looking at this.
Totally. Yeah, I'm like at such a disadvantage showing you this stuff in PowerPoint because, yeah, all the charts are interactive. I could toggle everything off. I could put one on. I could compare 300 to 350 to 350 to 400 and look at the differentials and see everything. And you could do that with almost all the charts. They're all really interactive. So, yeah.
Why do you think that the really low price, the 100 to 150, went up towards the end of 2017? See the black line?
Yeah, and part of that is because you get, you're selling one property a month and all of a sudden 3 come on. And because you're dealing with such small numbers of them, that it's really erratic. It's very volatile. So if you average one property a month for the last year, and all of a sudden 1 month you have a really weird month where 3 properties in that price range come on, now it looks like there's 3 months of inventory. See what I mean?
Some of those lower priced homes are nobody's going to want to buy, period.
Yeah, in some cases, right? I mean, because they're pretty rough.
Yeah, that's what I mean.
Yeah.
Could have foundation homes.
Yeah, in some cases that's probably true too. And so they'll stick on the market for a couple months. You may have inventory sitting there. Yeah. Yeah, that's probably true. All right, so you guys get this. I wanted to show you a little bit of seasonality. You can see this. This is basically 2010, just the all prices combined. And you can see this was the low, and we kind of went up here. And what's crazy is people kind of see months of inventory is up, and they're hearing about these numbers and how it's changing. Yeah, it's up, and it's up a significant amount. But look at the big picture. It's nothing. It's still really, really low. Okay.
Can you go back to the big picture one? So there were some questions. I know there's some new people here, right? There you go.
Yeah, what he said. That sounds exactly right. Any questions on that as I continue to move on? All right, so same type of thing. We're doing months of inventory this time, and I'm showing you, I think I only go back a year. So basically this shows you a year's worth of data, months of inventory. This is by price range. So you can see the months of inventory is hot by price, really low, and as you get up into the higher price range, the number of months of inventory increases. So you've got a larger number of months of inventory down here. Any questions on that? What?
You turned your mic off?
I did when I was in the bathroom. Now it's back on. Did you guys more? Thank you. Am I going to need to separate you two? All right. This is the same type of idea we've talked about before, months of inventory, except superimposed on the same chart. This is January through December. The red one is last year, 2017. The green one is the year before. And you can see the months of inventory is a little bit higher for almost every month, except the last couple here, than it was in the previous year during that same month. And you kind of look at the blue lines for those that are up front, you can see that this is still historically very, very low compared to what we're seeing there. Okay? So you can go look at this and say, how does this compare monthly to the last year in February? You know, was February a good month for months inventory? And you can kind of compare them. Make sense? All right, where am I? Oh, fix and flip and distressed property stats. So before I show you stats, I'm going to try to trick you, okay? So you've been warned. So where do you think buy, fix up, and resell deals come from? Do they come from foreclosures? How many people think that when you want to buy, fix up, and resell deal, fix and flip deal, that they come from foreclosed properties? Raise your hands. Yeah, anywhere, northern Colorado. In general, foreclosure properties, northern Colorado. No one thinks they come from foreclosures? Okay. How many people think they come from short sales? 1, 2. How many people think they come from long days on market? You're finding properties that have been listed for 4 months, 5 months, 6 months, which, by the way, during a normal market, that's normal for a listing duration. Okay? But if you're doing like now where days on market is really, really short, properties that have been listed for 6 months, are you finding deals, fix and flip deals, by looking at properties that have been listed for 6 months or a year? Raise your hands. Is that where they're coming from? 1 or 2 sort of half hands? What about the lowest price? Are you going to go look for fix and flip deals by doing what Brad had suggested and finding properties that are priced at $100,000 because there's foundation work and you're going to be needing those? Do you search for them by lowest list price? Raise your hands. No one. Okay. What about something else? And if so, what is the something else? What is the number one indicator for fix and flip deals?
Off market.
Off market? Okay, that's not an indicator, but I mean, sure. Off-market distress, like doing mailings? Okay. So the data I have is all stuff on the MLS. So we're not going to cover any off-market stuff. Yeah. Math. Yes.
Do you say math or meth?
You could do a search by keyword, and meth would probably be one that would be a good indicator to find those deals. Absolutely.
Age of the property, look for stuff that's dated that hasn't been renovated yet.
So age of property, and then try to find stuff that's dated. That's a possibility as well. Paul?
I like that idea. I would just add per square foot.
Price per square foot?
Dollars per square foot.
Okay. Yeah.
Math. Tax data.
Okay, so someone's seen this presentation before. All right, so let's go over some stuff. This is the number of foreclosures we had in our marketplace for a whole bunch of different cities, so you didn't think I was kind of stacking the deck. In 2017, in Evans, there were 2 foreclosures. In Fort Collins, there were 7. In Greeley, there were 11. In Longmont, there were 5. In Loveland, there were 3. None in Severance, 1 in Timnath, 1 in Wellington, and 1 in Windsor. That's the total number of foreclosed properties sold in the MLS. So not a lot. Back in the big day, in the day when we had a ton of these things, 2008, in Greeley alone, there were 638. Greeley in 2009 had 398, 394, 288, 150 in 2012, 83. So you could see that we used to have a ton of these things. And they were a great opportunity for a lot of investors that were looking for fix and flip deals. Foreclosed properties that needed work, they can come in there and they can buy properties from the bank, oftentimes at a discount, and buy them. We're not seeing that anymore, partially because our inventory of foreclosed properties is significantly depleted. Yes?
Also, I've talked to some people who've looked at foreclosures, and banks aren't willing to accept selling at a discount anymore as much.
I think that's true. We're seeing a lot of properties that are being sold by banks selling for retail. Yeah.
And then there's people who are being educated so that they don't have to go into foreclosure and they're finding
I think that's true too.
investors who can reach out to them and
But even if you bought a property, you put 5% down or 1% down, and you waited a year and then you were in foreclosure, the market's been going up 5 or 6 or 7%. So you don't even have to go into foreclosure. You could actually sell it with a real estate agent and come out and be whole. And that's another thing, is that when the market's going up faster than we're normally seeing, you don't need to wait around for it. So not a lot of foreclosures. Same stuff with short sales. We used to have a bunch of them. Last year there were 1, 3, 5, 4, 1, 1. All the other ones were zeros for the different cities. The biggest one was there were 5 short sales in Greeley. Not a ton. Not a ton of short sales out there to do fix and flips. So here are the number of buy, fix up, and resale properties with at least a $30,000 spread that happened in our MLS last year. And I'll show you how I do the data so that you understand this. Imagine for a minute I hated trees, and I went and I printed out every single MLS sheet in the MLS. And I stacked them up to here. I pull the top one off, 1, 2, 3, 4 Main Street. I then go look through the stack at the other ones that were listed until I try to find a pair for 1, 2, 3, 4 Main Street that happened within the last year. If I can't find one, that is not a pair. If I do find one, that is a pair of transactions. One time it was in the MLS within a year, it sold. Another time it was in the MLS for a second time and it sold. That is a pair of transactions. I consider those properties that were sold twice within a 1-year period. I consider those a fix and flip pair of transactions, especially if you go in there and you see that there was work done or a value added. Okay? So that's a pair. And I'm looking at the number of pairs of transactions that happened within a 12-month period that had at least a $30,000 spread between what it was bought for and what it was sold for. Does that make sense? So I'm finding fix and flip deals that happened in the MLS. And this is the number that there were. So this is 2017. Basically, in Fort Collins, there were like 49 of them. Okay, so there's what, 30-something people, 40 people in a room or so? How many people want a fix and flip deal? Raise your hand. Wow, it's actually much smaller than I thought. So usually it's most of the room, and I was going to say, so that's the whole inventory right there, if all of you took one. There's not a ton of these out there. Okay? Now right here, there's probably Longmont had 30-something, Greeley had 30-something, and then Loveland had, I don't know, high 18, 19, 17, something like that. So all those combined, maybe 150 total. Not a lot of those, and that's $30,000 spread. Now, unless you have a real estate license, if you have a property and you sell it, you have commissions and closing costs and things like that there, that significantly eats into a $30,000 profit, right? If you have a 6% commission going out on a $300,000 property, that's $18,000 of your $30,000 spread right there. So not a lot of profit margin in these, on those either. Bought in the MLS and sold in the MLS. Yep. Yep. Okay? So not a lot of them. This shows you the actual numbers for the fix and flip deals. Yep, so you can actually see them on there. I'm going to skip it. And then this one shows you the actual gross profit between what they bought it for and what they sold it for on average by city for a year. So for 2017 in Fort Collins, the average spread was $61,000 and change to do that. Now, what does that not include? That's the difference between what it was bought for the first time, what it was sold for the second time. One thing it doesn't include is real estate commissions going out. It includes real estate commissions when they buy, because those are usually included in the purchase price. But it doesn't include real estate commissions when they sell. It doesn't include their cost of money, financing, hard money, regular loan, cash, whatever you're going to do. It doesn't include that. It doesn't include repair money. They need to go and put $10,000, $15,000, $20,000, $30,000 in repairs. It does not include that either. It doesn't include closing costs. They have to pay for title insurance or anything like that. It doesn't include utilities and things like that on the property while they're holding it. So all of those come out of those numbers. So in Berthoud, it was about $20,000 per deal, $39,000 in Evans, $61,000 in Fort Collins, $54,000 in Greeley, $58,000 in Longmont, $43,000 in Loveland, $30,000 in Severance, $11,000 in Timoth, $50,000 in Wellington, and $20,000 in Windsor. That's what the average was for those transactions in that year. Okay? Any questions on that? Is that encouraging or discouraging? Yeah. Depends on where you look at it. All right, so as Brian pointed out, because he's seen the presentation before, I went back and I looked at all the data for the number of fix and flip transactions that occurred in the MLS, and I tried to figure out if I wanted to find these, because I was able to say these were the fix and flip deals. Let me go back and look and see if I look at foreclosures, or I look at short sales, or I look at price per square foot, or I look at lowest price, or I look at something else, what is the easiest way? What finds the most of these? It turns out the number one way to find a potential fix and flip deal is to actually compare the list price to the taxes. And you use that ratio and you sort that list by the ratio of list price to taxes. And this makes sense because what are taxes? Taxes are based on what the assessor thinks the value of the property is. And the property owner fights their assessor's value to try to minimize that. So it's usually pretty accurate. Right? So when you look at it that way, taxes are a proxy for value. And so if you look at what a property is listed for and you compare it to the actual tax value, the actual taxes on a property, you get a ratio. And if you sort all the properties by the same ratio, you find out the one with the most favorable ratio of price to taxes, which is really a price to an estimated value. So if you can sort the MLS by that field, which you have to export it all and do it manually, you can't do it in the MLS itself. But if you do that and you sort those, you will get the list. You will be able to find most of the fix and flip deals toward the top of that list. Okay? And this chart kind of shows some of that data. This basically, each one of these blue dots shows you the ratio of property taxes to list price as a percentage. And this shows you dates. And then the red dots are the actual fix and flip deals. And in case it's hard for you to tell that they're kind of floating to the top, like what's it, fat to the milk churning thing, whatever you call it, kind of raises kind of up to the top there. This is a better way of looking at it, because this is the percentiles of that taxes to list price data, and each red dot is now a listing. Going all the way back to 1998, you can see that there are a lot of them that are like above even the 5% line. So basically all of these are exceptional ones. There's a little spread here, but they tend to kind of focus on top. Now you can still find these deals at the bottom. There still are deals where you can find where either the taxes are entered wrong, or the taxes are wrong, or the list price is appropriate for the thing. I mean, there's lots of times when you see it down there, but the majority of them are floating on the top, and that's the best way to find them. This is Windsor. You can kind of see a little zoom in of that. Same thing going back to 1998 through 2017. You can see the number of fix and flip deals that are all there. So if you're trying to find fix and flip deals, this is the way to do it. And clients of mine, I have a special web page for identifying these properties where I already do the math for you, and you can see all the properties listed by the ratio of taxes to list price, and it just shows you those properties right there. And then I have comping tools linked right from it to make it easy to find. Do you have a question, Royce?
I was just going to ask how often you're putting that information.
Every day. They cannot set up email alerts, but you can email yourself daily and say, go check the website. All right. This is Loveland, same type of data. You can just see it's the same trend. There's Fort Collins, in case you're wondering. Okay. So as prices go up, as interest rates go up, as rents don't go up quite as fast as prices and interest rates, the cash-on-cash return, your cash flow on a property that you're getting, is actually being suppressed. It's being restricted. And so what we're seeing here is this is showing you a chart of cash-on-cash return on investment, and this is showing you the price per total square foot of properties. So the higher the dot is on here, the higher the price per square foot, the higher the quality of the property in a lot of cases is. Because higher quality properties tend to have a higher price per square foot. And then it shows you kind of the ratio there. So you can see that properties that have really high price per square foot tend to have really low, poor cash-on-cash return. Properties that have lower price per square foot tend to have a little bit better cash-on-cash return. But one of the things I want to point out to you here, and by the way, this is going back, I think, 6 months. This shows you right here, this is 0% cash-on-cash return. This is buying a property with 20% down and making exactly no cash flow. That's what 0% cash-on-cash return means. And this is a 3-bedroom property in Fort Collins. Okay? So there weren't very many properties that had above 0. A few, 1, 2, 3, 4, 4 that are currently, 5 that are currently for sale, and maybe a dozen and a half or so properties in the last 6 months that had better than that. And some of those properties, when you actually go look at them, are not necessarily ones you want to buy. Okay? So why am I telling you this? I'll tell you that in a second. I'll show you also, this is Loveland, same type of idea. Here's 0. There's not quite as many for Loveland either, although there's probably a little bit more than Fort Collins, but you can see that same idea. And then this is Windsor. This is 0 for Windsor. Okay? And then this is Greeley. This is 0 for Greeley. So there are more cash flowing deals in Greeley. Doesn't this make sense? When we want cash flowing properties, we typically go to Greeley. We typically don't buy in Fort Collins. It's much harder to make the numbers work. I guess I'm not going to tell you whatever I was going to tell you, and I don't even remember what I was going to tell you now. So I will come back to it if I remember. This chart, though, who wanted rent numbers? Okay. So let's turn the mic off for a second and pretend that I didn't say what I just said, which is that I go and scrape Craigslist for all of the rent data so that I can chart it for you and show you what properties are renting for in Fort Collins and those local markets. And so this data is primarily from Craigslist. For clients, we also subscribe to a service at the end of last year because the joke is true. If you guys ask me what rents is, I'm always low. So we provided a service where we actually subscribe to it. If you want rent comps, email me, which really means email Tammy, and ask her for rent comps. Give us the address of the property, and for clients, she'll do that for you. But basically, this shows you rent comps for the properties. It shows you week of the year. And there's a couple spots here, because I'm scraping it from Craigslist, and my coding is not perfect because I'm not checking this every day. There was a period of time where I actually had an error in my code. Craigslist changed what they were doing, and it took me several months to figure out that I wasn't getting data, and so there's a weird kind of like blank spot in there. And I only started doing this back in like February of 2016 when someone asked me if I would do that for him. I was like, all right, I'll go code it, and I did it on Sunday afternoon. So this is when I started. The blue lines is last year in 2016, and then there's a weird part where I messed up the coding, and so there's a kind of big blank spot. But what I want to point out to you is this. So 2016 rent data, this is the average of all Fort Collins properties for rent combined, not by broken out by bedroom, and I can break out by bedroom and zip code and a bunch of other things. But it shows you that it's lower for 2017 than it was for 2016. So those of you that felt, hey, listen, it's harder to get the rents that I wanted to get in 2017 than I was getting in 2016, the data proves that that has been true. Okay? Now, there's exceptions. There's definitely some properties that you were able to get top dollar for, but there are a lot of things on an average basis that shows that the rents we're getting in 2017 were lower than 2016. And so that was the case, except right here. I think 2017, it peaked in sort of the summer here, where you had a couple of months where you're able to get a little bit more. But overall, the trend has been that 2017 is lower than 2016. So that's been the trend. That last year, 2 years ago, 2016 was higher rents than we're getting in 2016 on average. Make sense? Do you guys expect that? Okay. Okay. Couple more slides. So there's a book. You guys don't need to read it. One of the things I like doing is going and finding, 50-year-old books or 20-year-old books or whatever it is, and looking back at what people were teaching real estate investors at that time, or complaints people had about real estate investing at the time. Because my philosophy is nothing is new. All the problems we're facing right now are not new to us. They've happened before. So this book from 1975, it was basically talking about the early 80s, kind of when it was there. It was subtitled The How-To Book of Making Big Money with Rental Homes, book about buying rental properties and renting them out. And they're complaining about the same things folks are complaining about today. Tell me if this sounds familiar. Prices are too high. Okay? So back in the 80s, they were saying prices are too high. What were they back then? 50K? 60K? Okay? Interest rates being too high. Interest rates back then were much higher than they are here. Okay? But interest rates are high. Are our interest rates high? But we're complaining about them. They've gone up like, a quarter of a point, but they're at 5% now. Okay? Rents are too low. The cash flow is not good on these properties. Does that sound familiar? The same problems they were having back then are the same problems we're having today. Okay? What do you think the price of homes they were talking about? I told you, like $50,000, $60,000, $70,000 properties. What do you think the rents they're talking about are? Yeah, $300, $400, $500, $600 a month. Craziness. What do you think the interest rates they're talking about are? Well, it's like the 80s. Yeah, depending on when it was, 8, 9, 10, 12, 14, 18, some craziness. So back in 2004, kind of looked at stats tonight, investors were complaining real estate was too expensive. They were saying stuff like, I'm going to wait for a market correction. I'm going to wait for prices to come down. Right? They were all doing that. They were not getting good enough rent for the price. They were looking at properties, they're like, I can't make this work. I mean, the cash flow on it's not great. In other words, cash on cash return was not good enough. Now cash on cash in those same properties they bought are amazing. So if they bought that property and they had waited 14 years, now for the prices they're paying for the rent that they're getting, it's like grand slam home run numbers. Interest rates were low, but they thought there was a bubble. Was there? We looked at the data. We now have 15 years of data since then. Was there a bubble? I don't think so. Okay? So back in 2008, during the downturn, prices down a little. Some markets more than others. Greeley was down more than Fort Collins. Fort Collins low was like less than 2% on a price per square foot basis that it went down its worst year. Many people were afraid to invest though. Okay? So they were complaining 2004 and saying, I can't find deals, I can't find deals. 2008, a buying opportunity comes. Prices get suppressed a little bit, but they're scared. They don't know if there's going to be a huge decline in the market. They're afraid to invest. And many banks were afraid to loan them money. So the financing was harder. Some rents were suppressed. So you could go buy a property and get a deal. I'm able to buy this property and it's, this was worth $300,000 before. Now I could buy it for $270,000, but I can't quite get the rent I wanted to get because rents were suppressed during that time. You could buy it at a discount, but you're not getting amazing rents. So 2017, people are complaining market is too hot. Prices are too high. Interest rates are moving up. They're getting priced out of certain markets, and rents are not high enough to get cash on cash. Does this sound familiar? Right? So I have 3 questions for you, and not why do people like to complain so much. That question's free, smiley face. Question number 1, will you have the confidence to buy if there's a market correction? Historically, very few people did. They were afraid. 2004, they were like, this market's too hot. By the time 2008 came along, they were like, I don't know. The market's, it seems unstable. It's risky. Most folks do not have the resources, harder to get loans, and money in other investments tend to be depressed. So when you have a market depression overall, the stock market looks risky. A lot of times the stock market's down, and you've got less money there. You're like, well, I can't invest now because my investments in the stock market are down 30%. I can't pull money out. I got to keep it in. So you get scared about doing that. And very few people have the emotional strength to go against the trend, to kind of fight that depression and say, now is my time to invest. So question number 2, will you regret not investing now if property values double in the next decade? So 2 years ago, 3 years ago, whatever it was, their prediction was basically house values in our local marketplace are expected to double in the next 10 years. So are you going to regret it not buying a property this year, knowing that property values are probably going to be close to double in the next 7 years, 6 years? Okay? Are you going to regret that? I'm not sure. If the market goes up 10% next year, it's like getting a 10% discount today. So imagine for a minute, I had a client, I sat down with him. He says to me, so James, I'm gonna hold off. I'm gonna stay on the sideline for a little while. I'm gonna wait a year or 2 from now, and then I'm gonna invest when we have a little market correction. I said, oh great, no worries, that sounds good to me. So talk to me about your numbers. So they said, so 2 years from now, I'm gonna go buy a deal. I said, how big of a discount do you need to get 2 years from now? He said, well, if I can get a 10% or 15% discount, maybe a 20% discount a couple years from now, that would probably be a pretty good deal. I said, well, the market's been going up almost 10% a year. If you buy it today, it's the same as getting almost a 20% discount 2 years from now. So why not just buy it today? Why wait 2 years from now and then have to go have a very limited selection of the properties you can get at a 10 or 15% or 20% discount? If the market doubles the next 7 years, as predicted a couple years ago, then buying today is like buying at a 50% discount. If interest rates move up, locking in lower interest rates now is almost like getting a discount and improved cash flow. If interest rates move from 4 to 6, it's almost like getting a 1/3 discount on the property because your cash flow is based on interest rate. Does that make sense? Because your interest rate just went up. All right, question number 3. Cash on cash return, I totally agree. In our marketplace, the cash on cash return right now is almost 0. And I talked to another real estate broker in Boulder, and he told me, he's like one of the top agents in Boulder, and he works a lot with investors. He said to me, in Boulder, investors are putting 30% down to be break-even cash flow, not even positive. And that Fort Collins is becoming like Boulder. We're having to put up 20, 30% down just to be break-even. Not to make positive cash flow, to not have to feed the property. Okay? So it is only one of the 4 areas of return. If cash flow is 0, if appreciation, if the properties or values are only going up 3%, you put 20% down, you're still getting a 15% return on appreciation. Your loan pay down, which we proved in the class, is 5.5% for that. And then your tax benefits are almost 14.55 from gross depreciation. So combine those, it's like 35% even if cash flow is 0. My predictions. Before I go into my predictions, which is the last thing, this is a slide of some of the smartest economists in the world predicting where interest rates will go. So back in 1985 or so, they basically started to predict where they thought interest rates would go. This is the little red line. And then this is what interest rates did. They jumped up for the next 3 years. And then eventually they did go down. Okay? Back here, they tried to predict it. They said interest rates are going to go down. They were actually right there for a little while, but they were not quite right where they thought they were going to be. In 1990, they predicted they would go down. They were right there. 1985, they thought they'd sort of levelize out. They kind of went down a little bit more than that, kind of came back up and hit it. In 2000, they thought they were going to stay where they were. They went down. 2005, they thought they were going to go up. They went down. 2010, they thought they were going to go up. They went down. 2014, they thought they were going to go up. They went down. 2015, they thought that they were going to go up. And they have moved up a little bit, but nowhere near that. This is 5. Okay, we're not anywhere near that. So the smartest people in the world have a hard time predicting the future. So I'm not going to do a very good job, but I'm going to tell you what my predictions are. If months of inventory remain low, which I think it will, market's still hot, a lot of demand, very popular place, we're going to see continued upward pressure on price. So I think prices will go up. We're going to see low days on market. Properties are not going to stay on the market for very long. It's going to continue to see that. We're still going to see above asking price offers. May not be as hot as it was 2 years ago, but it might be as hot as it was this year. I could still see it being about as hot. And on really good popular properties, we're still seeing properties go above asking price. I had predicted, unless we get back down to all-time lows, it will be less extreme than this last spring or summer, and I'm going to continue with that prediction. So my prediction was pretty close. Because the 2 years before, it was an extreme that it was really hard to deal with. People were just like, I'd rather not even make an offer if I'm going to be one of 19. And that was why it was crazy. Interest rates will continue to inch up. This will decrease your buying power and your cash flow. So act early, especially nomads, get a property. And then dollar cost average or dollar value average. Basically buy a property every year. Either buy an increasing property every year or invest the same dollar amount every year so that you acquire properties. But I would rather see you do that and participate if the market goes up or average your costs down if the market goes down. Rather than buying 10 properties today and then next year the market goes down 10%, I'd rather see you buy 1 or 2 today, 1 or 2 next year, 1 or 2 the year after that, and just average it over time. And that's why the Nomad plan is so good, buying 1 property every year and acquiring them. It's still hard, but charts show it is possible to do buy, fix up, and resell in a hot market. Not foreclosures or short sales, buying properties you can add value to from the MLS. So that's what the charts suggest for those. Any questions? No questions? Everyone got to ask their questions as we went? So no time for demographic data. I've got a whole 2-hour slide deck about population trends and demographics, but no one wants to stay till 11. So enough stuff on data for tonight. Enough market stats? Awesome. Well, thank you all for coming. Stick around for the class after the class, and we will see you next week for portfolio optimization.